Vivek in San Francisco. Thomas Westwater in studio in Chicago today. Dylan Radigan will be back tomorrow. Promise. We'll take you through the rest of this hour here as we wrap up the trading day. Futures market closes at 5 Eastern. If you're on the platform on tastylive.com, the website, welcome. Thanks for coming. If you're not in the chat, come to YouTube, join the chat. Tell us what you think of this action, this pre-FOMC trading action. Of course, the Fed meets tomorrow for their May meeting. Markets in a slight holding pattern here. Slight weakness in equity markets as we get a slew of tariff headlines, both from Treasury Secretary Bessent and Trump himself, while he meets with new Canadian Prime Minister, or first-time elected Canadian Prime Minister Mark Carney in the White House. Some language choices used by Trump, I think, that are indicative of where we should be looking for the skate to be next, or the skate to where the puck's going to be next, I should say. Moving on, bonds were weaker all session long until a very good 10-year note auction this afternoon. Foreign demand still very high, bid-to-cover ratio above its 6-month average. Good news there. Doesn't really matter for gold or silver, though, because, again, it's a sell America type of day for most of the session. So with stocks down and bonds down most of the day, you have gold screaming to the upside. And if we were to end the day here, it would be the high day close of the year for gold prices. We look to the currency market, the dollar's down. Oil has staged just terrific rebound. The sector performance isn't fantastic, but we turn to the charts here, Ilya. 56.26 right now. We're at the 1-week moving average. We're backing away from that zone that we've been discussing the past few sessions here, from Futures Power Hour on Friday to, I suppose, right now, where we have the NASDAQ and the S&P both at the 618 retracements of the yearly high-low range. We're running into the April highs. Now we're backing off. Is this simply people, covering, getting some dry powder before tomorrow?
I am not ready to say that this is a reversal lower that is confirmed, despite the fact that I am short and I want it to be a reversal that's confirmed. It looks like a very compelling evening star candlestick setup, no matter where you look, S&P, NASDAQ, Russell. But it is premature, because if you want to put a line in the sand here, for me, that line on, let's say, the S&P would be to get back under, let's say, 55.60, or better yet, to get back under the swing highs from the initial April bounce. Let's call it 55.40, something like that, 55.30. So if you went back to that massive green candle that you see there, the initial kind of icing of reciprocal tariffs north of 10%, that's sort of your line in the sand. If you can get back under that, then you have an attempted recovery that's failed. That's sort of your point where your rally from April lows becomes defined not as the beginning of a lasting move higher, but as a correction in a bear market that's been confirmed as over. So if you want to really be rigorous about the price action says X versus Y, that's where you have to get under for confirmation. Now, I'm already short, but I'm not adding. And I'm not going to do anything else, I think, with stocks here until we get some clarity on what the dust settling will produce tomorrow. We'll get to some other things I put on today, though, I'm sure, as we shift assets.
Yeah, Thomas, it's a bit of stock weakness here today. The earnings reactions that we've seen from companies like Palantir obviously didn't help the picture over the course of today's session. Likewise, there was some tariff news with respect to pharmaceuticals, an executive order signed by President Trump to promote reshoring of drug manufacturing here. Of course, the pharmaceutical companies don't like that because it means smaller profit margins. So we do see that those names in the biotech space. We could go to an ETF like XBI, has a pretty bad session, down 6.64%. What's your read on the market, though, ahead of the Fed tomorrow, I think is the bigger question, as I just asked Ilya. Do you see a market that's simply settling in before the Fed, or does the Fed not really matter because it's all priced in, if you will?
I don't think this Fed decision matters too much. It's going to be one of the lower impact ones of the year. Rate odds are 2-3% of a cut. That means we're not getting a cut. We had 10, 11, 12 up days there in a row. This is kind of expected for that to retrace a bit in my mind. Like Ilya said, I agree with the technical levels he mentioned. I don't really think there's a degradation of the technical structure here. I think it's just some settling before FOMC. I'm not buying or selling right here. The only individual thing I got a little long in shop. That's just an earnings play for me. It's not an expression on my view on the market. Gold, utilities performing well today, everything else down. It's pretty typical risk off right here. I don't think it's sending any big signal to us one way or the other. So I'm not taking a direction in the equities right now.
I have no incentive to put anything on right now, but Ilya, I think the point that you and I discussed yesterday still holds in terms of establishing trades in the equity indexes here as we look to FOMC. There is a way to set up a position if you want to do this in the typical tasty manner where you're looking to harvest the volatility. If you went to something like 40, just for the sake of this conversation, staying in ESM 5, if we went to 41 days, so we're not looking at the the AM expiry, the recent swing highs in the market from April 2nd come in at 57.73.25. And so doing a short call spread near those levels, say short the 57.25 along the 57.50, it's basically 1-to-1 at 41 days to expiration right now. You'd be keeping your risk constrained to the high. And if we break the April 2nd high, then you could say technically we're in a territory where we're now fully in breakout mode, right? We've digested the move. We've cleared the horizontal resistance. We'll probably have to sell at a higher level if we want to be short. Why would we do this to the short call spread as opposed to the short put spread? The short put spread, if we look to the recent low that comes on April 30th, that's at that 1 month moving average, the decline of the February, March, April swing highs here. That's 54.55. And so trading on the other side of that, if you wanted to go a little bit wider than it, you can get a better probability of profit, but the risk to reward is not a 1-to-1. You're risking more than 3, almost 4 to make 1. And so if you're doing this in the typical tasty way to look to harvest the vol, the way that you can do this that's less risky, so to speak, is by keeping your position constrained to the recent highs. There's a lot more downside than upside if you're wrong in your directional assessment.
Yeah, if you look at the sort of overall, so look at sort of the full breadth. You're kind of, and if you put the 50 non-fib on there, you can see that there's a kind of range in here between essentially halfway in the move and about the 62% level. And so you have the big high and the little high, one just above 4,800, one just above 6,200. So ostensibly, you could say, you know what, I'm just going to really widen it out and want to stay within this thing. But there's really not that much vol here. Do you think the juice is worth the squeeze?
Probably not for an iron condor. Thomas, I don't think directionally neutral could work. You're close to the 50% mark, and you could do it around the yearly high lows if you want to give it enough time. I have the chart here tuned to AMD right now. AMD earnings are due at 4:15 Eastern, so they are expected in just a few seconds. We'll wait to see that market reaction. Thomas, as we get ready for AMD here, and any second now, we do want to get your take on let's just go with the take on the S&P. No dead air time. Thomas, do you think that the short iron condor is a better way to do this? Would you rather play S&P 500 directionally neutral here, or would you rather do something like sell the call spread and perhaps try to pick off a top as the market begins to turn from resistance?
I think you could do directionally neutral for the time being. The market's gotten into a phase where we're now expecting things to kind of trickle in. So unless we get some kind of big news, we'll get a trade deal here and there over the next couple months. There's not going to be a major re-escalation. President Trump's rhetoric has kind of shifted back to more unpredictable the past couple weeks as the market's gone up. I'm not sure if, that has anything to do with the market direction. It might. But, I think the market's done with big shocks for right now. Of course, you say that until there is one. But on the preceding path, I think you could play directionally neutral. I'd probably do it with more of a slight upside bias if I did anything. And look at that. AMD looks like it reported something good.
There we go.
Yes, they did report. AMD is in EPS at 96 cents versus 93 cents expected. The revenue is 7.43 billion versus 7.12 billion. That gives you, and you just disappeared on me, that gives you a year-over-year earnings growth rate of 38%. That looks right. I'm looking for something on the Q2 outlook. All right. AMD guides for Q2 non-GAAP gross margin at 43%, which includes approximately 800 million of tariff charges. So that is higher than what the market was expecting. I see the consensus forecast is for 35% gross margin moving forward, coming down from Q1's 50% for the most recent. So margin's a little bit fatter. They don't see tariffs being as big of a negative impact as some other companies may do. You're getting a little bounce here in stocks broadly across the board out of this. The NASDAQ up slightly, was off closer to 1% now, only about 0.8%. Same for the S&P 500 here. I don't think this necessarily is a game changer heading into tomorrow's chart setups, but more chop and grind. It's not the end of the world for another semiconductor. Thomas, going back to the charts here and looking at a potential iron condor, if we wanted to play it around the April 30th, April 2nd swing levels, the 57.73 and 54.55, we could size that up here. It's going to be real tight, though, because the market vol is still fairly elevated. You're going to risk one to maybe make two close to it. You could also just blow this out right now and just go to the one standard deviation move, maybe go 100 points wide, and you'll get something in the neighborhood of that, 63% probability of profit. You're risking four to make one. So depending upon your tolerance, there are technical levels to work around that would speak to a choppy sideways environment. I think the broader question, though, is, and I don't know if Tom would be happy that we're saying this, is vol at a floor? We have this gap here between April 2nd and 3rd in the VIX where we have Liberation Day. And for some reason, not that I would ever do technical analysis on a non-stationary time series like the VIX, but I can't help but notice we're not falling back through the pre-Liberation Day opening levels. Mm-hmm. Ilya, do you feel like volatility is a little bit understated right now in the short term?
It could be. Again, this is not the kind of series where extremes are easy to discern because it's mean reverting by its nature, sort of the way the indicator is set up here. So I think what you have to believe, essentially, is that things are well enough off the extremes that we saw in early April to say that we're probably not heading into some kind of a sovereign U.S. crisis. That makes sense. But also that we've reset to about the levels where we were on volatility going into sort of the second half of February, March, which is around the growth scare kind of really starting to metastasize in markets. And we can see that vol from about sort of mid-February starts to unclench and markets go into this kind of sideways thing if you look at the S&P, if you look at NASDAQ. I think we are close to a growth scare coming back to the forefront. And if this is kind of the reset area for those kinds of concerns, take a look at those tops in early March. It's not much higher vol. It's maybe closer to like 30. It looks like we're maybe a little bit light relative to that. So I could see it expand in that direction, especially if you get a Fed that I think really comes off vague. I think what the markets want is not vague. And it's obviously well priced in. They're not going to do anything. We know that. But if you look at the way that Fed funds is set up, the markets have exactly the same tally of rate cuts that the Fed is forecasting through the end of next year, but the markets are priced for urgency. They want 75.
End of this year, end of next year, just so I know what you're
End of next year. End of next year.
Okay.
100 basis points for the markets, 100 basis points in the Fed forecast. But markets are priced for 75 this year and 25 next. And it's very clear. Even the numbers are rounded in the market's own forecasting. It's very kind of cut and dry. That's a little bit more urgent than what the Fed is saying. The Fed is saying 50-50. 50 basis points this year, 50 basis points next. So the market understands the Fed's not going to give them anything, but they want some kind of something that tells the markets, yes, we know. We're coming. We just need to hang our hat on something. We need evidence. We can't look like we're kowtowing. And the GDP numbers were, let's say, fuzzy enough to be debatable. The NFP numbers were fuzzy enough to be debatable. The inflation numbers have started to come off, but the 3 and 6 month annualized rates are just starting to cool. We've only seen maybe a month or two of that, depending on where you look, CPI or PCE. And PCE looks worse. So when you look at all of it, you want, I think, or at least the markets want, for the Fed to tell them, yes, we know. We're coming. The bias is there. Just give us some space to sell this thing. If the Fed is vague, and it's another one of these, well, we don't know what's going on, sort of the way it was in March, where they just throw up their hands and go, well, typically tariffs do XYZ thing, but who knows what they'll do this time. Okay, have a nice month. Bye. If that's what that is, I think there's a little bit of room for vol to expand and for the markets to disappoint. Not in kind of a catastrophic way. I think bonds might be a lot more action-packed than stocks when it's all said and done.
Thomas, talk to me about commodities here today. I just saw news hitting the wire just now that India has launched missiles against Pakistan, hitting 3 different sites.
Oh, God.
We've previously flagged how India broke the Indus water treaty a few weeks ago as a result of a terrorist attack in Kashmir. You're not seeing much action here after hours, but would you attribute any of the moves that we're seeing in gold or oil today to any of the geopolitical risk that we're seeing come out right now of the world?
Yeah, I mean, not necessarily between India and Pakistan alone. We've seen geopolitical risk elevate in the Middle East more broadly. And, you know, this military action with Pakistan and India, it was expected. You know, other nations have tried to mediate, get them to cooler heads to prevail. It looks like they're entering something that's going to perhaps be a more prolonged conflict here. And of course, anytime you get conflicts like that with any major nation, India, you're going to get some geopolitical risk premium priced in. The Houthis, they're continuing to launch missiles, of course, at Israel. It looks like their strategy is getting a little more effective lately because they have gotten some missiles through that the defenses have not been able to interdict, and they're doing that by launching multiples at a time from different sites. We used to call them POO sites in the military, point of origin. So that it looks like they're getting a little bit more aware of how to get around these missile defense systems, and that's not good overall because it could increase the prevalence of them. It could invite retaliation. We've already seen Israel do that. So now it's going to be on the U.S. to, are they going to ramp up these attacks on the Houthis and try to get these, interdict some of these capabilities that they have. talks between Iran and U.S. indirectly are also ongoing. It looks like Iran is taking a pretty firm stance with not wanting their complete uranium life cycle to be dismantled. It looks like that's a hard line for them right now. We'll have to see how talks go. Trump visiting Saudi Arabia soon. They're, of course, going to talk about this issue in depth. And we'll have to see what comes out of that. But right now, geopolitical tensions are higher. You're seeing some of that in crude oil. I don't believe it's all of it. China also came off a week-long holiday, so you've China traders coming back onto the desk, seeing that oil prices are low. They might be figuring it's a good time to buy right now. That doesn't mean prices can't go lower, but in the short term, that's helped give it a bounce. And we'll have to see how these tensions go in the Middle East, Pakistan, and India. Things are getting hotter for sure.
I suppose the angle that interests me here as it pertains to the trade war is that China recently came out with a statement calling Pakistan an all-weather ally. And so maybe it's in the United States' best interest to support India as much as possible in order to make things more difficult for China. It just seems like it's another front that could open in this burgeoning Cold War with the world's two largest nations, economies, superpowers on either side of the Pacific. Well, these are headlines that are worth following, I think. Obviously, they could have impact on the commodity market. But the commodity market today was obviously the big story. Stocks meandered around. We can talk about gold shortly. I'm actually a little bit more interested in what's happening with crude oil here. Thomas, can you make sense of this to me? I know Ilya's going to say OPEC's a joke and doesn't mean anything, so we'll save that for a moment. What gives? 400,000 barrels plus a day coming online? We're overproducing. Why is the market completely disregarding this week?
Yeah, so if you look at the term structure in the options for crude oil, you've seen contango in the back end of the curve kind of increase over the past couple weeks. However, that's now moderated. So OPEC is going to pump more, but what the futures are telling us is that there's not as much supply fear in the market right now as there was just a week or two ago. Backwardation, the front end of the curve is still strong. 40-cent premium in the prompt spread. Crack spreads are good. So, refiners, they're going to pump product through as fast as they can right now while they have those margins. If the crack spreads start to fall apart and downstream you're getting less demand, you're eventually going to take that's eventually going to move upstream into the producers who are taking oil out of the ground. For now, though, it looks like China's economy is going to hold up rather well versus expectations at the beginning of the year. But still, we're under $60 a barrel. Prices are weak relative to where they've been the past couple of years. So we're kind of going through, we're reflecting some of the economic weakness that we're getting from trade talks, trade wars, things like that. It's about picking a bottom. Is the bottom in right now? We have like somewhat of a double bottom forming. Maybe a move
maybe
back,
around 55.
Yeah, maybe a move back up to mid to low 60s. You got a pretty good point of resistance coming around 64 right there. We've had some selling, buying in that area, churn to selling. In this peak between the double tops. So, right now I'm keeping my crude long on for now. If we get around 61 to 64, I'm going to take it off and then kind of probably get directionally neutral. Maybe even a short bias in there with the trading. But right now, geopolitical tensions are helping. We have Trump going to Saudi Arabia again. Oil is going to be another talking point. The thing is, there's speculation that Saudi Arabia is doing Trump a favor by doing this, by pumping more oil, keep fuel prices low. And now that favor has to be returned in some way. So we'll probably see something come out of these talks in terms of strategy in the Middle East that resolves around that. But right now, I think this bounce, I wouldn't be surprised to see it sell off a little bit here in the coming days. But I think we hold this double bottom for a little bit around 55, 51. I wouldn't expect it to get much lower than that.
There's always one story that just about oil in Saudi Arabia that blows my mind. Apparently back in 2003 or 2004, this is a long time ago. I was in high school when this happened. And I remember so distinctly the news story coming out in my AP government class, that Saudi Arabia had offered the U.S. a security arrangement that if the United States would bring Saudi Arabia into the security umbrella, Saudi Arabia would produce enough oil annually over the next 30 years to keep oil below $28 a barrel. That obviously didn't happen. Now, Saudi Arabia has that production capacity if they needed to do so. I obviously know what Aramco can do. But their break-evens, the fiscal break-even for Saudi Arabia is up around $96. So when you say Saudi Arabia is doing Trump a favor, that very much tracks with the entire fiscal situation there. Mm-hmm. Ilya, from a growth perspective, there's probably not much to like here today. It's not like we're seeing any of the data pick up in any substantive form or fashion. There's nothing really on the calendar for today's session.
Right.
Do you see, I know we joke like OPEC is a cartel in name only, but is this price action illustrative of that point of view, that they can make noise in the short term, but the market is going to quickly disregard them nearly every time as they have for the past several years?
I mean, I think that's what you're seeing in the price action here, certainly. I mean, you have a gap down around the OPEC and company, OPEC plus, squawking about, oh, we're gonna pump more oil. Okay, you all have not been able to get the discipline in your ranks to meaningfully pump more oil when you've needed to hit a quota ever. This group got together in the wake of the big oil sell-off in 2014, which was, of course, the shale revolution in the U.S. really hitting fever pitch, and which, by the way, very funny to then run on drill, baby, drill, because, of course, those peaks were in the Obama administration. Anyway, so you get this blow-off in oil, and the cartel gets together with like-minded producers like Russia and goes, okay, we're going to get together and have discipline around a quota. They haven't managed it yet because other members are constantly cheating all the time. And most of the cheating occurs on underproducing when prices are down, because nobody is in the business of selling cheap oil. Especially, as you've very rightly pointed out, a lot of these countries' entire fiscal architecture depends on not selling cheap oil. And so what we have then is a situation, I think, where, yeah, they can say that, you get the gap, we're right back to the top of the range on crude, where we've been consolidating, maybe forming some kind of a double bottom, maybe not, but we're essentially back to the starting line. So I was short going into it. Last week, I closed that out after a few weeks holding it, because it looked like we got to a meaningful level of support, and there was no immediate hair on fire reason to think you're going to crack it. So I think Thomas's point is well taken. I think you probably meander here for a while unless you finally get a real growth scare. And for now, at least, you need the U.S. economy to unmistakably fall apart for that to happen, because China just posted you an 8th consecutive quarter of economy-wide deflation. Their PMIs have stalled at 0, no growth. Europe is meandering at basically no growth as well. The PMI has just shown us that. Just like since the middle of last year, the U.S. is the only game in town. The problem is it is now converging on the weakness elsewhere, as opposed to spilling out prosperity to let everybody else converge on it. And so what there is to fear in crude is that there's finally some evidence that the U.S. economy has withered. But the GDP numbers were, let's call them, fuzzy enough to be inconclusive. The NFP numbers were fuzzy enough to be inconclusive. It'll be a while. You need to see it for real.
Today's definitely not a growth scare kind of day when you look at the metals market. We can see copper is up 1.19%, continuing its tepid bounce off that move into 455, 460. Silver up 3% here, which good news for those of us that are still long. But Ilya, I think you want to wax poetic a little bit about gold here today.
Oh, yes.
What's working well here for the gold market? Actually, Thomas, let's go to you first. What's working with gold here? Is this as simple as what Ilya mentioned earlier? You mentioned earlier Chinese buyers back from holiday, seeing the state of the world and saying, oh, I can get gold at $3,200 a U.S. ounce? Please and thank you.
Yeah, I mean, the gold story is pretty simple here. The Fed's eventually going to lower rates. You have an environment where inflation could be stalled a little bit. Growth fears. I'm staying long. I have a long call spread right now. I'm going to stay long. I think you get pullbacks along the way, but I think the uptrend's going to remain intact here. There's nothing really to dive into too deep. It's just a good story.
Mm-hmm.
Is that all there's to it, Ilya? It's just a good story, narrative flexibility, yada yada, the same things as it were.
It seems like it. Gold was pretty early on the kind of, I almost hesitate to call it a currency crisis, but it had all the currency crisis type of stuff.
By the way, now that we have this India news drop, it's still climbing here after hours. It's up 3.5% now. It's added another about $10 in the past 15 minutes.
Exactly. And I think this really kind of speaks to what's going on here. Gold has a lot of narrative flexibility when the fog is thick. People reflexively buy it. I mean, consider the surge in gold when Russia initially invaded Ukraine. Why should gold rise? For that reason. Other than just knee-jerk, we don't know what's going on. There's nothing that makes gold safe in a warlike environment. Not safer than very liquid dollars. Certainly easier to use those to escape missiles raining down on Kiev if that's your prerogative. Gold bar isn't going to get you nearly as far as a wad of C notes. And so the entire sort of conceit with gold markets when the fog is thick seems to be, listen, I don't know what's going on. I don't know what the relative balance of risks is, and I don't know where things land. Let's just buy some gold and hope for the best. And that seems to be the knee-jerk reaction whenever the fog is thick, as in a war, or it seems a trade war. And so you have this kind of inherent bid, I think, and that India situation only just compounds the same sort of dynamic. And it certainly doesn't hurt that China has become a net buyer again, although their ETFs are shedding it, the official channels are buying it, and where you land on a given month is a mixed bag. But what you do see is that gold seems to have this kind of indifference to the dollar, indifference to yields, just this relentless march higher, just because the fog is so thick. And I think that continues.
Fog is thick. It continues. It continues for right now. India says that justice is served with respect to the response. So clearly,
so it's over.
Try not to escalate beyond here. Trump is out now. He said that he did not call Carney governor today. He hasn't yet, and maybe he won't. Quote, he had a lot of fun with Trudeau. FXC here. We talk about.
Are you not entertained? Are you not entertained?
Listen, one of the things that I have like talked with you guys about this, like Trump is a very skilled communicator and he's very funny.
He is very funny.
And
funny goes a long way.
And I'm a New Yorker. He's been in the newspapers my entire life. So like Donald Trump's shtick has been, if you're a New Yorker, Donald Trump's shtick since childhood. So yes, he has not called Governor Trudeau. He's not called Prime Minister Carney, Governor Carney yet. So that's, I suppose, the good news. Currency markets today, though, Thomas, I started the show talking about Sell America. Feels like it was back and forth for most of the session. Outside of that it was a good 10-year note auction today. Foreign demand very high, bid to cover ratio above the 6-month average. Until then, it was stocks down, bonds down, dollar down, gold up. And as we wind out the session, the long end recovers after the auction, but it's still stocks down, dollar down, gold up very aggressively here. And where is the dollar failing? It's failing right at the September swing lows, former support, turn resistance. Oh, and there's that 1-month moving average here. It's a bearish outside engulfing bar today for the dollar. It signals imminent decline.
Yep.
Thomas, what's the deal here? Sell America back on? Are gold and the U.S. dollar telling us everything we need to know about stocks?
Yeah, I mean, I've said earlier that my view is being long non-U.S. dollars in this environment. I think that makes sense. And I think it makes sense until the trade war is resolved. It's just... We've seen it when it started. There was this big rush out of the dollar. There's people calling for this regime shift or this shift in the narrative where the dollar's not going to rule anymore. I don't think that's true long term. I think the dollar is going to survive as the world's reserve currency. It's taken decades and decades to build that reputation. I think it would take more than a few months to fall apart here. We kind of saw it in the euro. The euro was up a lot. You had news out of Germany that the coalition government couldn't get formed. A little bit of a surprise there, but the euro, it maintained its gains. It trimmed some of its strength, but it survived. And the story right now is, your dollars are probably better off in a currency like the euro, the yen, something like that. I think that narrative is going to continue on for a while here. I got out of most of my yen and euro positions last week. I didn't put them on. I was planning on putting them on at the beginning of the week. I didn't get to it. But I'm still thinking we get more dollar weakness coming down the pipe here over the next few weeks, couple months maybe. I think this story still has more room to run.
I agree.
Oh yeah, there was a comment that Trump made today that I think reinforces this view, right? Because if the whole idea about the dollar decline is that countries implicitly at the macro level won't have the need to recycle money back into dollars and dollar-denominated assets moving forward because the trade flows just simply won't be there, right? And the only way out of this hole is for a North Star, right? We know that trade deals in some form or fashion, some structure's coming. There are differences between trade deals and trade agreements. Trade deal is not legally binding. It's not passed by Congress. It's set by the executive branch. A trade agreement is negotiated through congressional approval, and that remains in place because it's not executive order. It can't just be turned off by the next guy who occupies the Oval Office. Reporter Megan Casella noted today, and I think it's worth going over this here, in a long monologue in the Oval Office beside Canadian PM Mark Carney this afternoon, the president appears to say that trade deals his team are working on are not deals in the traditional sense, as they will not have to be signed. Trump says the U.S. does not care about accessing foreign markets. We don't care about their market. They want a piece of our market. The deal will be naming the price that people are going to have to pay to shop in the United States, unquote. So pointing this out here, he says and Megan's takeaway here, the reporter's takeaway, the latest insight we have to how the president is thinking about the path forward on tariffs, naming a price to pay to shop in the U.S. It appears he wants some tariff to remain in place and possibly with everyone, and it downplays what to expect in terms of deals. What Trump is describing won't bring certainty to markets because you're making a long-term investment based on unsigned agreement that's subject to change again. So Trump wants trade deals that are not signed, handshake agreements with countries that, like, we're not going to raise your tariffs. How does the business plan around that, I think, is my main point. How do we get our way out of the woods if that's the attitude?
Person walks into a bodega, knocks a shelf over, and goes, "It'd be a real shame if something were to happen here. Why don't we figure out a price for it not to happen?" Price is negotiated. Week later, that person ends up, I don't know, sinking into a river with a strange amount of cement around their legs, and then something else happens inside the store with some different person.
Hypothetical or tale from Ilya's childhood? Go on.
I grew up in Moscow in the 90s, so
I'm aware.
So do with that what you will. But the story here very much is one from that kind of a childhood, because I remember my mom being an early business owner in quickly privatizing Russia and having to navigate competing extortion gangs for her language school, because that was how it was going down at the time. Of course, this doesn't create certainty. And that's the whole issue. When you have a handshake agreement like this, what you've done is exactly what the president wants, which is to give him the ultimate power, where he can mandate largesse and say, you have been good kids over there in Japan. Here's a lower tariff. But you over there in the European Union, very naughty, higher tariff for you. Don't even come asking China, you're getting coal for whatever holiday you all like to celebrate, because I'm not going to pay attention to those specifics. I'm the king and I don't care. So this is the sort of setup that we're shaping up here. Businesses cannot reshore on this basis. They need a 5-10 year window where policy is going to be what it is. The tricky thing with trade policy by traditional trade deals, it's difficult to do, but it's also difficult to undo. This is not that. And if what we're basically looking for is handing the president essentially fiat over trade policy, depending on how he feels on a given day, I mean, fine, but businesses aren't going to take that as a cue to do much of anything but hoard cash and wait. And by the way, as we get closer to the mid-term elections, they don't even have to wait that long. They just need to buckle down and go, all right, let's see what happens when people have to start campaigning for these midterms in barely 6 months' time. And then we'll see who does what where.
Yeah, my congressman held a town hall over the weekend, and people were asking him about his tariff position, and he's like, well, we got to just give the president a chance. He has a negotiating window. But he did say if trade deals are not signed by the end of the 90-day window, he thinks that Congress should act on their authority. That's Mike Lawler. He's one of the 10 House Republicans in one of the swing seats. So maybe Congress will act soon. Not going to hold my breath, though, because 90 days is still a long way out. We have to wait until July, and I will definitely be blue in the face by July. Here's the interesting thing about the euro and the currency markets here today. We have a headline when we wake up this morning, at least when I wake up this morning, guys. The German chancellor, well, not quite German chancellor, he is not confirmed in the Bundestag. And the euro is falling back this morning. They quickly gather everyone together. Apparently some MPs were late, missed the vote because they were sick. They vote again. He gets into a position of authority. He's now chancellor. And the euro is able to close the day higher, kind of brush off this weakened Chancellor Merz. I would point to what's happening here. We move below yesterday's low in the euro. We close above yesterday's high. We've seen this so many times before. That's a key reversal or an engulfing bar, depending upon what you want to call it, where you identify it in the trend. We're not quite at the low off the recent swing high, so not quite a key reversal, but I digress. Off the 1 month moving average, where we've seen support over the past few weeks since the middle of April. And the 1 month here, you get that Morningstar candlestick cluster turned through it at the start of March. And ever since that bottoming effort, you see that the 1 month has been holding up here. So you get this nice turn higher in the euro, higher in the Japanese yen here today. It's moving back through key swing levels that were established initially after Liberation Day. You have an Australian dollar, which is continuing to break out. Ilya, I know you're on this. It's now on a yearly
and the yen.
Closing high here.
I bought
and the yen.
Pullback in the yen as well.
Right, so the dollar still doesn't look too hot. Higher commodity prices obviously good for the Aussie. On a day when oil's up 3.5%, I find it, or 3.25%, I find it particularly noteworthy that the yen is able to do what it does. So strong yen, strong gold, weak dollar, weak stocks.
It all has a flavor, and the flavor is lower long end yields. Take a look at ZB here, and the little engine that could. It's been getting beaten up, but I bought a little bit of a TLT vertical here today because if you look in on, let's say, an 8 hour or a 4 hour, interesting little upswing here today that if you look at the shorter term time frames seems to depart from some recent consolidation. Seems to want to change of pace.
Sorry, I'm looking through some of these headlines here. CNBC's this is like this is very well written, very funny framing. Trump downplays tariff talks. We don't have to sign deals. The Art of the Deal author, President Donald Trump, said in a surprising comment Tuesday that the United States does not need to sign deals. That's just excellent journalism. That's pretty funny. Yeah. I like the framing there. Yeah, I mean, like, is this a walkback? Right? Bessent saying today that there's no negotiation with China presently.
Now there's not.
Now there's not.
Before it was untenable for there not to be a negotiation. Now there's not a negotiation. It feels very much like the Fed is going to come out, say nothing of substance, betray absolutely zero bias again, and say, listen, you know how you all are sitting here wondering what's going on? Us too. See you in June. And the markets are going to take stock of what's just happened and say, well, which way is growth likely to err? Is it going to err on the upside? Chances are not. And the Fed isn't coming. It's not coming at least until July. Okay. Let's just dig this foxhole here.
India says that justice is served. Pakistan says no, it's not. They will be responding to India's attacks in Kashmir today, even though India said specifically they did not target any Pakistani military sites. So we have, just giving where the time of day is, they're going to be waking up across the world shortly as the sun rises on May 7th. Tonight could be an interesting night in markets if we see some of these headlines continue to pile up here as we make our way through the trading day. Guys, 5 minutes left here in the session. So tomorrow, the Fed, we're expecting nothing. I think that makes sense, right, folks? Mm-hmm. If you're in the chat and the Federal Reserve is going to put out new economic forecasts next month, and you have a president of the United States saying today, we're not negotiating with China. We don't have to sign any deals. Do you feel like you could have the courage, the confidence, the ability to move decisively on rates or policy or offer a signal for when the next move will be? Likely not. But that's the upside here. We're now in a calendar period where we have meetings May, June, July. So if the Fed does decide that things are wrong, guess what? We get those forecasts next month. So we'll get the new growth, inflation, unemployment, yada, yada in June. And with those numbers in hand and a bunch of data in our pocket, the Fed could probably make a more formidable case to think of something to do, if that's hold or cut. But the time horizon for that to occur, probably not tomorrow, Ilya, Thomas, you guys have your exposure coming out of today. Will you be making significant adjustments before the Fed tomorrow? Thomas, what's on your book right now? Will you be keeping it?
No, I'm not going to. I'm staying long crude. I'm staying long gold. I've been long ZB, ZN, taking a little bit of pain since last week. I'm going to stay long there too, though. I think it's going to be like you said. The Fed's not going to offer much, or like Ilya said, the Fed's not going to offer much. The ball's in the White House's court right now. I'm unconvinced on any long in the equity market right now.
Ilya, what are you holding? What are you keeping? What are you getting rid of?
I got all kinds of put verticals in the stock market, which obviously I've been nursing for a couple weeks. They were early. I have them in SPY, in the Qs, in IWM, so I'm basically biased short on all three of the indexes that we look at here. I'm long the Aussie, I'm long the yen. That's working. I got a little bit long a TLT call vertical today, looking for basically the markets to conclude that the Fed outcome means more rate cuts later, because they're going to be late and they're going to have to catch up, and that's going to mean that more easing goes into the back end of the curve. So I've got that on in a completely random thing that I'm probably going to be holding on to all year. I got long Brazilian stocks, EWZ, and I'm not looking for it as a trade. I'm looking for it as something to hold for a while. I think it might be bottoming. I think one of the main beneficiaries of a rupture is, between the U.S. and China, in particular on ag exports, and in particular on soy, is Brazil. And it looks like the political situation there ahead of next year's elections has gotten about as bad as it's going to get. It doesn't look like it's going to get any worse. So it seems like we popped through a range top here, and I'm just going to buy it and hold it. It's not anything that I have any reason to trade around. I just bought a straight up call. It's 240 days out, so it expires at the end of the year. So this is just a lark. Other than that, I'm just looking for the Fed to validate a lot of what we're saying. I'm long gold, I'm short the dollar, I'm long bonds, I'm short stocks. So risk off rate cuts. That's sort of the bottom line.
So you'd say you're sanguine about EWZ?
In the interim, yes.
In the interim. Okay. Yeah, for me, it's gold, it's bonds, it's notes. Gold still pressing the long call spread for a move back to all-time highs that was put on last week after taking a brief reprieve into being short, and glad that I switched when I did. But that, we see the black cat in the matrix. You don't look at the deja vu and think much about it. So that's working here. Silver longs, copper longs are still working, obviously. I really like the action on the utilities today in some of the names that I've been writing out for the past several weeks, like Exelon and Duke Energy, which are both still in these consolidative, kind of bullish pennant type of formations. And utilities, broadly speaking, you look at XLU, this is at the top of its range and looks like it wants to break out to, this is a fresh high for the year in XLU. Other than that, just meandering around. ZN is directionally neutral. ZB's there's directionally neutral, both on a short iron condor and a short put spread. If the Fed doesn't cut tomorrow, they're not going to fan the flames of inflation or growth, which mirror image of what happened in September, guys. Higher rates out of 50 basis points of cuts. I think you get lower rates coming out of no cuts. But we'll find out if we're all right or wrong tomorrow. Ilya, you and I will be back for overtime tomorrow with Dylan, purportedly. Thomas, you're going to be on with me prior to the FOMC, so we're going to give this to people all over again and look at the trade setups intraday. So I want to thank everyone for coming out, particularly if you're on YouTube. Make sure that you join us for tomorrow's sessions, pre and post FOMC coverage here on Tasty Live. So for Ilya Spivak in San Francisco, Thomas Westwater in Chicago, I've been Chris Vecchio in New York. Good luck trading. We'll see you soon. After this, there's a brief break. Then Ilya Spivak's back with Macro Money.
See you there, everybody.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Steven Atlanta, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really Tasty Live until about 2012. It made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with research. They share that research. It's not just trust us and do this, which is a very dangerous thing in the financial world. But learning about that in the Tasty universe, it starts to prove itself out, right? When you follow the methodology, you'll see those profits and you'll understand why a position did what it did. Sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
I'm just going to wait for the stock to dip, then I'm a buyer. Buying into weakness is a phrase used to describe the action of getting long a stock into a down move. It's a contrarian trade. Most people want to buy what's hot, the stuff making huge upside moves, the chart line moving up and to the right. Nobody wants the stock at lows. But it's hard to buy high and sell higher, rather than buy low and sell high. There is a phrase for this. When the time comes to buy, you won't want to. Trade size varies between traders. In a larger sized account, a trader might trade 10 contracts per transaction. In a smaller sized account, a trader might only trade 1 contract per transaction. The term tranche allows us to quantify and
Markets continue to leak lower as we get ready for what is the tentpole event for markets this week, No, it's not the meeting of President Trump and Prime Minister Mark Carney of Canada, although that certainly stirred up a lot of interesting pronouncements today. No, it's the Federal Reserve monetary policy announcement. We're going to dig into exactly why the markets are so soggy ahead of it and what it may bring here on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We're going to start just with a look at what the markets did here and why they are setting up the way they are for this announcement, and then take a look at what the announcement may bring and what the trade opportunity is shaping up to be in its wake. So here's just a kind of stage setting look here first and foremost at the S&P 500, and you can see here we kind of hit this former resistance at 57.24 thereabouts. You can see that there is a sort of range that's set up right here. Very tellingly, of course, this was the place where we gapped lower on Liberation Day. This was the sort of congestion range established after the markets initially got their growth scare around the deployment of tariffs in the beginning of the year. They paused to consider what happens next. Then we get Liberation Day, which of course gives us I dare say, something currency crisis adjacent kind of an episode where bonds, stocks, and the dollar all crater simultaneously in response to the president's tariff policy clarification. Then, of course, we walk that back, and at least the tariffs north of the new baseline of 10% are put on at least a temporary hold, and there's a massive rally. We then threaten to fire Chair Powell and then not, and ultimately that's what unclenches markets more convincingly. Notice we've basically erased all of this kind of sovereign risk kerfuffle, but only that, and have stopped exactly where Liberation Day would have left us were it not to have occurred at all. And so the interesting bit, of course, is since the beginning of the week, the markets have walked back a bit from those levels. It's not at all clear that the rally is over, but at the very least, it has stalled at both a level of inflection for price before, and clearly see it here with the naked eye, and also a kind of a critical inflection point in terms of the narrative and in terms of time. Now, as far as the Fed policy announcement itself goes, the expectations are very clear that the Fed is not going to do anything with rates at this meeting. We can see there's no change that is baked into the cake here until you get to July, September, and of course there's no meeting in August. But we can see here that we go from 4.38, the effective rate currently, because of course the Fed sets things in ranges. That's the midpoint, the effective rate currently between the Fed's target range of 4.25% to 4.5%. To get to one cut being priced in, we'd have to get to 4.13, and you can see that falls somewhere in between July and September here, which of course makes sense. That July meeting is on July 30th, so right at the end of the month. So indeed, if the pricing structure here is telling you that there's no cut in July, it's because for most of the month there isn't one. But it happens just as the calendar turns to August, right before then. And so by the time you get to September, obviously we're sub 4, and we already have that first cut on the menu. From there, another cut is already on the menu for November. We'd have to get to 388 there, and of course by November we're already there, 371, and to get still a third cut from there, we'd have to get to 363, and you can see we're already lower than that, 358 for December. So you can see them here. Cut, cut, cut. 3 of them on the board. And so if you look at the overall structure here, you can see very tellingly, here's your 3 cuts, almost to the basis point baked in here. And for next year, 1 cut. A little bit extra if we consider the 29 basis points versus 25, but only just barely so. So what you then drill down on is 100 basis points in overall easing. Of course, there's some rounding here, but clearly this is in line with the Fed's own forecasting. This is, in fact, what the Fed has been saying since December. Here's the December projection. It was to go from 4.4 down to 3.9 this year. By the way, why 4.4? 4.4. There's the current effective rate. So from 4.4 to 3.9 is 50 basis points. From that down to 3.4 is another 50 basis points. So the Fed agrees with markets, and they agree with the Fed. We're looking at about 100 basis points in cuts between now and the end of next year. But clearly the Fed is looking at 50 basis points spread evenly over that forecast, whereas the markets want more urgency. They want 3 rate cuts up front and 1 next year. Why so? Well, we've gone over the reasons in detail before, but we'll do it again here briefly. Of course, we just got the latest batch of PMI numbers from the U.S. this week, reinforcing the idea that a cool down in the service sector has given us basically standstill on U.S. economic activity growth, down from the headiest levels that we'd seen since early 2022, where, incidentally, we hovered for most of the second half of last year. But as soon as the calendar turns to January, well, that falls apart. And so we are now basically at no growth at all, or barely any. Of course, this is, as ever, in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So at 50.6, we're growing, but only just barely so. And in fact, at the weakest pace here, referencing back 17 months. A competing PMI survey, again, finalized this week, comes from ISM. They have a slightly weaker view of manufacturing, 48.7 versus 50.2. They have a slightly stronger view of services, 51.6 versus 50.8. But the bottom line, we're somewhere around 50 and change, maybe a little bit north of it, for a weighted composite, considering services is, of course, a much larger part of the economy than manufacturing. We're probably tilting to the positive side of 50 because the weight from services here probably matters more in any kind of composite construction than does manufacturing, because of this asymmetry in the economy. And so the bottom line, net, seems to be to land a little bit north of 50, which is exactly what we get from S&P Global. In other words, we've slowed to near standstill, and you can clearly see the direction of travel here. Basically, since the beginning of the year, these things are going down in tandem, much as we get from the other PMI as well. So there's quibbling at the details, but the overall story is of economic deceleration, and that part is absolutely unmistakable. So why won't the Fed cut? Well, we've heard them talk extensively around the idea that what these things are, ISM and S&P Global, and for that matter, consumer confidence surveys from the Conference Board from the University of Michigan, which are likewise flashing bright red, that this is survey data and sentiment-based. Granted, it's a very good proxy for GDP, especially the PMI numbers. But what the Fed wants is something more concrete. It wants to hang its hat on some kind of set of hard numbers. And we can see from their forecasting what they think the trajectory is and what they're worried about. Take a look at the change in projections for growth and inflation despite the stasis on rates. We adjust to lower growth from 2.1 to 1.7, from 2 to 1.8. We reprice to higher inflation from 2.5 to 2.8. For the core, a little bit more stable. For the headline, even for next year, from 2.1 to 2.2. And of course, this lines up exactly with what Chair Powell told us both when this meeting occurred in March and since, which is that they have no idea how these tariffs are going to impact the economy, but what they know historically is that tariffs tend to raise the prices of stuff because they are essentially a consumption tax on imports, and that this tends to weaken growth because then people have less money to buy stuff and buy less of it. And of course, we know that the biggest component of the economy by far is household consumption. So we know what the Fed thinks are the risks: weaker growth, higher inflation. We know that this pulls the Fed in divergent directions. Weaker growth says rate cuts, higher inflation says no rate cuts. And so the Fed is saying, we just don't know, and we're not going to make a call until there is hard data telling us which way we need to jump. And yes, we see the survey data, but we need it to be more concrete. We need not just for businesses to be afraid, we need for actual pain to materialize. So far, that has been somewhat difficult to engineer. Here is the data that you have most recently, of course, from the GDP report. And ostensibly, you have your kind of hard data slowdown. The 0.3% contraction in GDP is the first negative quarter in 3 years. Last time was the 1% decline in the first quarter of 2022. So, okay, do we have the hard data? Well, not so fast. If we look at the internals of that GDP report, and we've discussed them in granular detail here before, much of that negative number was the off-the-charts surge in imports. And since GDP is consumption plus investment plus government spending plus net exports, that is exports minus imports, this little sliver of imports minus this big chunk of imports obviously gives a huge downdraft on growth. Now, overall, the export sector is tiny relative to overall GDP. Net exports are maybe only about 5%, 4.5% of overall GDP, whereas consumption is 65.8% or more. In the recent numbers, it was closer to 69. But the incredible magnitude of this import surge really overwhelmed the picture. Similar story for this surge in inventories that's making for this massive jump in investment. And of course, all of this is front running of the tariffs. In the first quarter, companies know the tariffs are coming. They don't know exactly what they look like. And so they're trying to buy as much as they can from overseas to build inventories as big as they possibly can to weather a shock for as long as can be made to work. So not surprisingly, there's a surge in inventories and a surge in imports, which makes these GDP numbers fuzzy and easy to argue with, even though the part that matters, the consumption piece, actually gives you the smallest contribution since back here in the second quarter of 2023. So almost a 2-year low on household consumption. That's the part to be worried about here, but difficult to say that this is quote-unquote hard data with so much fuzz in the figures. It's a similar story for the jobs report, but somewhat in reverse. Notice it somewhat beats expectations. 177,000 jobs added in April versus 130K expected. Now consider what this means. This is outperformance, sure, to the tune of about 47,000 48,000 jobs. Except the March number was also revised lower by an almost identical amount, revised down by 48,000 jobs, from 228 to 185. So did the labor market look any better in April than expected? Well, pretty much no. It was exactly as expected, because whatever outperformance you got at the top was taken away in the revision for the prior number. And as we can see, going all the way back to early 2023, the 12-month trend in these 2-month revisions has been negative. That is to say, we've seen some chop up and down on these revisions, but the trend has been toward revisions down to a weaker labor market. And this has been with us for a while. So again, fuzzy data, unclear exactly what the Fed can do with it in an unmistakable way. On the inflation side of things, we've started to see some ticking lower. In particular, the core PCE number that we got reported last week gave us core inflation of just 2.6% year on year. That's certainly a welcome sight. It's the lowest since June of last year. So we're sort of at the bottom of the range that we have carved out recently. But it still looks a bit tenuous. When we look at the 3-month and 6-month annualized rates that the Fed likes to look at to get a view of inflation's dynamics, we can see that only in this most recent set of numbers did we come down a bit from this peak in February, where the 6-month rate and the 3-month rate accelerated. Now, we saw something very similar last year. There was about a 3-month upswell in these dynamics, and this, of course, got the Fed delayed and sounding frustrated, saying we want to cut rates, but we can't because inflation isn't making the progress that we want. We saw it making progress the prior year, but now our hands feel tied. And so they dithered and dithered and dithered until they got to September here, and finally had their big 50 basis point cut right here, said a bunch more easing was incoming, but then, of course, inflation started to go the other way. And at the beginning of this year, really had another sort of unwelcome spike. So far, we're only 1 month into a cool-off. If this was at all instructive, then the Fed has a few more months yet that it needs to see before it's convinced that this thing is moving in its desired direction. Now, for their part, the markets are seemingly giving the Fed permission to cut. Here are the break-even rates for the 5 and 10-year U.S. Treasuries. Essentially, what this tells us is the implied inflation expectations in the bond market, derived by taking the difference between nominal rates, which is what we typically talk about when we say bond yields, and real rates, so-called TIPS yields, inflation-protected security yields. And there, once you take the difference, you get the inflation adjustment that it takes to get from nominal to real. That tells you what the bond market thinks about inflation expectations. And so when you look at what's been happening here, shock of shocks since mid-February or so is a sharp turn down in inflation expectations, which only became more acute at the beginning of April, and these things have not rebounded. Now, the timing here is, of course, very much an auspicious thing. It is the same timing as the turn right here. So just as in mid to late February, stocks said, oh no, growth scare. The PMIs are starting to show that all of this fire and fury around tariff policy is creating uncertainty. Businesses and consumers are holding back on spending. That is a dampener on growth. The economy is slowing and doing so quickly. This is where the market started to freak out. Not sovereign crisis freak out, just heading to recession freak out. And you can clearly see this is where inflation expectations peak and start to come down. Because ostensibly what the markets are saying here is, yes, maybe there is a one-off price increase from these tariffs, Fed, but also we're looking through that to what that price increase will trigger. And that is demand destruction and recession. And so on net, inflation will be lower, not higher, because whatever one-off increase in the price will not be sticky. The economic slowdown, on the other hand, that's going to bite, and that's going to hold. So we see inflation leveling down as though to give the Fed permission and say, you're worried about the wrong thing, go ahead. But that's not enough for the Fed to really hang its hat, or so that it would seem, especially at a time when it is under increasing political pressure. Now, the president has helpfully walked back his threat to extrajudicially fire Chair Powell. That's, I suppose, helpful, but there is certainly no shortage of reversals from the White House, and that's the state of play right now, but who knows if it will continue to be the state of play going forward. And the Fed is very much aware that it is only as good as its credibility. It can't twist the arm of every interest rate in the economy. It has to be a credible lead to follow. And if it feels like it is becoming subservient to political influence, well, then it's not very much of a lead, and the markets will not follow. So, at the risk of getting the entire credit structure unglued, the Fed is not inclined to look like it is kowtowing. So it needs solid, hard data evidence to make the pitch that easing can begin on its own merits. So what we have here then is probably a Fed that comes out vague again and doesn't say much of anything. It says, why would we make a determination here one way or another? Nothing has changed. The data has been mixed. We don't have any more clarity. The fog is thick. We'll see you in June. And to the extent that the markets seem to want more urgency, again, they want 3 cuts this year, and the Fed is only telling them to expect 2, that kind of vagueness is likely to disappoint. So what you might then see is perhaps some extrapolation lower for stock markets. We'll see if they actually make a break through this former resistance turn support right around 55. I would argue you need to do that to really and truly cement that the down move is back in play. Otherwise, this could still be the start of something new that goes higher rather than just a correction. If you got through this level here, well, then the dominant bias is again reasserted on the downside. But the real active story might be here in the bonds, where just as the Fed dithered last year and the market started to make headway to price in more rate cuts later, because the Fed ostensibly is going to have to cut, is already by that point late, and has to then cut more to catch up, so too the markets might conclude is the case this time, and that might see yields disproportionately lower at the long end of the curve. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth. Back with Chris for Futures Power Hour on Friday. And, of course, both overtime and this show as well. On with Victor for Tom, with Victor and with Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
If you don't come from money, working with money sounds like the quickest place to get to money. So this idea of allowing money to work for you was fascinating with me. And then the more I get into it, the more I realize it was just a big competition. You know, it's like a big poker game with really smart people who know game theory, and nobody knows tomorrow, but they're all just taking calculated risks. And when I figured out that's what it was, like it wasn't this weird world of like somebody knows exactly what's gonna happen and this guy's got great stock picks, it's all just calculated risks, that gave me inspiration that like, well, I can do that. So I think spending a lot of time when I was young to learn different option strategies and to learn stocks, options, futures, Forex, crypto, to be able to go where the opportunity is, I think is the most important. Getting hooked in a strategy, it's cool, I respect it, but I tend to think I like to go wherever the opportunity is.
What is going on, everybody, and welcome back to Risk of the Week. Today, we do have another Risk of the Week. We're going to put one on. As you can see, it's getting down close. It's getting close. Gus, I know it's 3-1. I know I kind of yipped my way up a little bit in there. We'll talk a little bit more about that another time. But anyways, what's going on, everybody? Gus, what's going on, my brother? How are you feeling today?
I'm feeling good, doing well. We that intro kind of snuck up on both of us there. I think we're all off. The show is called Risk and Reward, everybody. By the way, we're doing Risk of the Week. That was the same thing that happened to me. I my eyes darted over like a sleeper agent activation. But happy to be here. Been having a good day, having a good week. I got no complaints. I do have an opener question for you here, Earl. We were just having a spirited discussion about this outside. What's the last Disney movie that you can remember going to see in theaters, like Pixar movie?
The last Disney movie actually seen in theaters? I don't even think I could tell you, to be honest. Maybe. I might have to come across something that'll be like, oh yeah, I did go watch it in theaters maybe a few years ago, but it's been a while. What is the topic of this discussion?
That's it. That was just my opener here. We were talking about it earlier, and about the differences, the generational differences, and it's just so weird because Disney, it's like, you know, if you're 2 years older than somebody, your experience with Disney and Pixar movies could be entirely different from theirs. So fun little discussion. For me, it was Frozen. That's the last one I can remember going to see.
Really? Okay, so why? I gotta ask, why did you go to check out Frozen? Well, did you think it was interesting, or were you going to something like?
I mean, OG Frozen was like 2013, and I think I was just kind of seeing any.
Ago?
Yeah. Oh yeah. Yeah.
Bro, we're getting old.
I know. I was kind of shocked looking that up as well. I was like, man, that's pretty recent. I don't know why I would have seen that in theaters, but no, I was just 12, just right on the verge of Disney not being entertaining anymore. It was the giant movie at the time. I've seen pretty much every Disney Pixar movie under the sun. That might actually be DreamWorks. I don't want to speak out of turn, but anyway, yeah, that's my icebreaker for the day. Everyone, let me know your favorite Pixar movie in chat. Toy Story is my personal favorite. I was a Buzz Lightyear kid.
Okay, that's up there. I don't know why you give me Buzz Lightyear vibes. I don't know what it is, but Toy Story feels like it adds up. I don't know. I would go Cars, or Nemo is a banger, bro. Nemo is a banger. That is a well-produced movie.
Finding Nemo is fire.
Yeah, and I don't know who makes Shark Tales. It's probably DreamWorks or someone else. But Shark Tales is another one of my favorites. Outside of Disney, The Social Network with Facebook and all that, I think that is such a fire movie. I love it.
Outside of Disney, and then you just pull like the most adult movie ever. Yeah, bro, I like Interstellar. Interstellar's my favorite movie. It's not what we're talking about.
That's why I made the disclaimer. But I got to ask you before we get into it again, today's going to be another risk of the week. We're going to be putting on a new position. We got FOMC tomorrow. So we got a lot of risk to put on this week. But before we do get into that, we'll do a little tour to market. Did you see the Nuggets game winner last night? I promise we'll be right back on topic after this.
I did. I was watching it live. I unfortunately was an OKC better. So it was my spread had already long sunk, and I was just kind of in it for the excitement of the game at that point. And yeah, that was a crazy ending. It's insane to steal one off OKC in OKC with the rest advantage. I mean, that's huge. That's huge to steal at home court. So yeah, Nuggets in playoff form.
Yeah, so Nuggets and 4 guys, I might be just a little biased, but great game last night. And I think the Warriors and the Wolves, that's going to be a series and a half. So we'll see what happens there.
Yeah, quite a shame my Rockets couldn't get it done. But yeah, sorry, go on.
Are you a Rockets guy?
I am a Rockets fan. It was a rough one.
Look at me.
It's all right. I was happy to stretch to 7. It's a really young team. We got like the next 10 years to build on this. I'm not super worried.
Yeah. I mean, it was Curry. We can go ahead and start jumping into these slides here. But hey, at least it was Curry. It wasn't some bum team. It's like, why'd you guys lose to them? You lost to one of the GOATs. So, but if Curry does win another ring, we're going to have some very uncomfortable conversations that I don't even want to have.
I concur.
Yeah. But we can go ahead and jump into these slides for the day. Risk of the week.
Let's do it.
First things first. Rivian. Okay, Gus, let us know what you got here.
Yeah, Rivian, getting a little deep in my EV bag here. Actually, I could count on one hand how many times I've traded Rivian in my life. Honestly, it's just never been super appealing to me, especially from an options perspective. It offers some sustained pockets of volatility, but generally, especially the last few years, has been moving, much like a low float stock does. But I'm liking Rivian in this spot. They have earnings after close today. Their post earnings performance has been consistently tied to their forward guidance, not their numbers, because they have been losing this entire time. And once again, we are expecting negative EPS. So this relies much more on their forward guidance, especially in this tariff environment. But they have quite a leg up in this tariff environment, especially in the automotive sector. They have all of their assembly is done domestically on vehicles that they sell in the United States. They're 100% of them are assembled domestically, and they have fewer imported parts than others in the sector, namely Tesla, who also does 100% of their assembly domestically for vehicles that they're going to sell in the United States. But they import a lot more parts than Rivian does. So I actually don't think that Rivian has too much tariff overhead going on here, which I think will be a good thing for their forward guidance, especially relative to these other automakers. As I mentioned, Chrysler, GM import 40% of their vehicles. Ford imports 20%. Chrysler and GM Chrysler and Ford have both suspended forward guidance for the year entirely until they can have more certainty. And GM slashed their forward guidance by about 25%. Yep. So that's what they're up against. Also, they have these R2 models, which are set to come out next year. That timeline's been holding up. They have a partnership with Volkswagen, where Volkswagen is funding development of the R2, and then Rivian is passing the EV developments back to Volkswagen to use on their own EV line. So, well-funded thing, seems to be on track. And this R2 Rivian series is really going to shake up the EV space, in my opinion. They're going to come in at a $45,000 MSRP, or that's the plan at least. Tesla Model Y is $44,900. Tesla Model 3 making sure I have my models in order here. Yeah, Tesla Model 3 is 42 and change, so it's going to be a very competitive price point on this R2 series of cars.
Yeah.
Looks like it's on pace. So the two things that are going to move this are tariff guidance and updates on this R2 series. I think tariff guidance is going to be very good, and as long as this R2 series is still on track, I don't even think it matters what numbers they report. So I'm liking Rivian. My trade highlighted there at the top. Bull call spread, bought the 9.5, sold the 10.5. Actually, I have 3 of them myself. And it's 10 DTE, so that's kind of where the risk comes into play here. But I have plenty of room, currently trading at what is that 13 and some change.
Okay, May 16th expiration. So we got a week and a half next Friday.
Correct. Yeah,
I like the EV. I like the EV pick. One thing I think is really interesting that Rivian is doing. A lot of the electric vehicles came out very expensive, around $100,000 for like their first vehicle. It's funny. Tesla kind of did that. Now they have cheaper vehicles to where they're trying to dominate the market. Rivian came out very expensive. Now they're going to be releasing the R2 maybe in 2026. And they're going to be lowering the price point on some of those models. Again, probably to compete with Tesla, like you just mentioned. But I think that's an interesting strategy. Pricing your vehicles very high to where they seem value a lot higher and then come out with some other lower end models. But that's going to definitely give Tesla some competition. I'm curious to see what these vehicles are going to look like, because I think you get that $30,000, $40,000 price point to compete with some of those Tesla models. I mean, now you have a decision to make. It's not just going to be the Tesla.
Yeah, and it's worth considering too that it's MSRP is new, rolling off the lot with 0 miles price. These things become very affordable very fast once they hit the market. Teslas are pretty accessible to the average consumer now. If you get a Tesla with decent mileage on it, you can get a Model 3 sub $20,000 these days. And I think that we'll see a similar trend with Rivian. And yeah, like you alluded to, I think that it is a very smart strategy, and it's one that Tesla employed as well, of initially making these very luxurious, high-end seeming vehicles that are unaffordable by the masses, and then gradually expanding into where the masses can afford them, and you've already asserted yourself as a luxury brand before your price point comes down. So yeah, definitely very interesting, and I'm bullish on it here. And it really, this R2 series and the research I was doing today kind of has me rethinking things a little bit. I might pick up some shares or take some leaps or something like that, because I do think Rivian shows some promise through the next year and a half.
Yeah, no, I hear you.
Earnings probably are already out. Thank you, chat.
Yeah,
yes, I forget that the market is closed. I'm always talking like it's just still market hours right now. Let's find some numbers.
No, we'll check it out.
You can go ahead with yours.
Are you checking out the screen?
I am going to get this figured out. Hey, let me see. I'm just curious about what their how they came in relative to EPS and whatnot. We have an earnings beat. Holy cow. Okay, so yeah, they were expecting a 77-cent loss, reported a 41-cent loss. Revenue came in almost $250 million over projections. They projected 997, came in 1.24 billion. So very, very strong numbers that I didn't even think we needed in the first place. So this one's looking like a winner. Thank you, chat. I appreciate it. Who said that?
You know what?
Thank you, Wandera. I appreciate you.
A win is a win. EPS expected to lose 77 cents per share, came in at 41 cents. It's like, that's a dub. Still came in and lost, but it's still better than expected. So how's the reaction right now? We'll take a look at it in the market here in a minute.
Yeah, we can pop over in a second. You go ahead.
Cool. Awesome. Well, this week I have to go with Old Faithful, Apple, right? One of the most popular underlyings I think to trade, but I'm going to have to go Apple here. Excuse me. Relative strength to the broader market index, it's holding up pretty well. It shows more signs that it might be a leader in its space rather than lagging behind other underlyings, which makes sense. I mean, it's Apple. Revenue services. We talked a lot about this. iCloud services, any type of services that Apple is utilizing is looking like it's going to grow from here on out. And again, a huge part of that is the iCloud service. I was really intrigued by the iCloud, and I did a little bit more research on that too. But Apple is definitely rolling in the dough on a lot of these services. We think with their iPhones, no. Those AirPods, another extreme revenue stream that they have. So it's like Apple's one of those things that it catches you off guard where they make a lot of their money, right? iPhone, most popular, right, tool that people have at their fingertips. But I mean, they're making a killing on every other avenue that they're exploring. But earnings are behind us. No volatility that I have to worry about. I know I held through the Tesla volatility. Not something I really want to do again, even though that worked out pretty well. But earnings are behind us, so it's making it a little bit more attractive for me. Maybe get involved on Apple here. And then historically, Apple tends to grind higher post earnings in Q2, and seasonality could give this trade maybe some extra tailwind. So we'll see how Apple does. It's a pretty, I want to say basic trade, The IV is all right on it. I believe we're sitting at about 33 right now, but I was checking out the options chain. I'm not really liking the juice on some of the premiums. So premiums aren't looking too attractive. That's another reason why I'm going to be buying a vertical spread. I was looking at buying a call, didn't want to pay too much of a debit for the call. So especially with FOMC tomorrow, I was like, you know what? I'm just going to buy the at the money call spread. It's a little aggressive, right? First, I'm buying the call spread, and then I'm going to do it at the money. But I'm going to be bullish. I'm bullish Apple. I'm going to be long Apple. Don't have anything else to worry about outside of some of those binary events like FOMC. So hopefully Rivian can drag this to the upside. It can somehow do Apple some favors. That would be awesome. But we're going to go with Apple. And I'm going to be choosing the May 16th cycle as well. I thought it was interesting. You mentioned the May 16th too. And when I was in the options chain, I was looking at the May 16th as well. So we're going to do Apple this week.
Yeah, and you make a great point about all the different revenue streams that Apple has. I mean, you'd be hard pressed to name an electronic or a device with a screen that Apple does not manufacture as it is. I've mentioned my Apple Watch before. I love this thing, and they got watches, they got AirPods, they got laptops and computers, they got everything in the world. What I want is an Apple TV, and I know Apple TV is a thing that exists, but not a plug-in. I want an Apple TV that is an Apple device. Like a
Apple TV, a TV branded by Apple.
Yes. That's what I would like, and I want it to be perfectly integrated into my suite with all my other devices the way that I have it now. I want to be able to be watching a YouTube video on my phone, walk in the door of my house, and flick the YouTube video onto my TV. That's what I want, and Apple has the ability to do it. But TV market oversaturated. I don't think they're ever going to do that. And it doesn't hurt to dream. People have been dreaming about the Apple car for over a decade now.
Gus, brother. I don't want to have to call you a boomer, brother. But have you heard of AirPlay?
I use AirPlay, yes.
Okay, valid. All right, I take that back then.
AirPlay is fine, and I have a smart TV with the YouTube app on it. When it's already about as seamless as it can be, I can close YouTube on my phone, open the app on my TV, and then I can immediately resume the video. That's all well integrated, and I understand that the functionality is there, but I know that Apple would find a way to make that more seamless if they tried.
Absolutely. 100%. See, this is one of the reasons why I was excited about Apple producing their Apple Vision Pro, the VR headset, because number one, I'm super intrigued about that space and to see how it's going to develop. And I didn't think Apple would get involved in something if they weren't going to come out with a high quality product that resonates with their brand, right? Apple's known to have a high quality feel. So I didn't think they would produce something that is low quality. So if Apple does produce something like a TV, I mean, I bet you can bet it's going to be really good quality, that Retina display, whatever it is. But that's one of the reasons why I was so excited about the Vision Pro. I haven't heard anything about it. I know it's super expensive, like $3,500 for a VR headset. You could just buy a brand new MacBook if you wanted to. But it seems like whatever Apple touches, it turns to gold, historically speaking.
I think that they actually have kind of done away with the Vision Pro. There was originally plans to make a V2. I don't know if they're doing that anymore. Chat is welcome to fact check me on that. But I think that they're kind of doing away with that. I am in the market for a Meta Quest right now myself. That's something that I've been looking into a bit more heavily recently. And I mean, to my understanding and from the reviews that I read, you get the Meta Quest for 10% of the price of the Vision Pro, and you give up very, very little functionality. But you also don't have nice integration with your Apple Suite, like I was referencing earlier. You know, you can do all kinds of things on the Vision Pro that you wouldn't be able to do on the Meta Quest if you already have Apple devices. I think that VR and AR is very interesting, and I'm wondering how close we are to people. I mean, and this is like some dystopian Ready Player One level stuff, but to people not even having screens in their house anymore, not even having a TV hanging on the wall, and everybody just has a Meta Quest, a Vision Pro, and you can all sit in the living room and watch your shows, or you can sync up and watch the same show or whatever you want to do. But the TV is just there in your augmented reality and not there in real life. You can buy a Meta Quest one time for $300 and in theory never have to buy a TV again if you didn't want to. You just got to wear this bulky thing on your head. But I do think that we're moving that direction. And I think that, by the time our kids are our age, I would suspect that that might be the way where we're at.
Yeah, I know you mentioned virtual reality, then you mentioned augmented reality. Also, I just want to say, I don't even think that's too far-fetched. I don't want to get all dystopian, but at the same time, a lot of the things and tools that we have today, we would have said the same thing 10, 20 years ago. So I don't think it's too far-fetched. And number two, I 100% agree with you. I think if it is developed, it's going to be more of an augmented reality first. Maybe if they can get it down into like a glasses size to where it's comfortable and doesn't look ridiculous on your head. because I know, even when the VR headsets were coming out, everybody was like, yo, everyone's going to live in their VR headset now. Like, what are kids doing? And I don't think it's going to be like that. Not until they can pack that hardware into such a small space, like a little glasses or something like that, for it to really, you'll see people wearing these things out in public.
Well, Meta has the glasses. People are rocking those Meta glasses now, but it's not augmented reality. Yeah, no, it's just it has all types of really neat functionality, and you can listen to music and take phone calls and things by just wearing the glasses, and you can record what's going on in front of you. And I think that there may be some little traces of augmented reality in there, but it's nowhere near what you get with the Meta Quest. But the point is, they've partnered with Ray-Ban to do that, and they totally just look like real glasses. You would never know, which that's the crazy part to me. Like Google Glass and shit like that, like it's this huge bulky apparatus that looks like it's from the future. They just look like glasses, which is very impressive. And so the fact that Meta is doing that and also simultaneously doing the Meta Quest, I think they'll bridge that gap before too long. Like, I don't know if we're 5 years out. Honestly, I think we could turn that corner pretty quick.
I mean, that's a really good question. And before we shift gears here, with some of the augmented reality features, I'm curious, have you ever seen those heads-up displays in the vehicles? Like, it'll show you just in the bottom corner of your dashboard, it'll show a mini hologram on your windshield. It's called the heads-up display. Is that, I'm just curious.
The dash is digi. The schedule was busy. Sorry, go on. That's what I think.
Always culture. That's the dash. No, I was wondering, is it kind of more like a heads-up display kind of technology on the glasses? Do you know what I'm talking about when I say that?
Yeah, I think that there is. I think that there are some elements of that. Like, I think that there is some kind of visual stimulus that happens when, like, you're getting a phone call, or like maybe you have text pop up or something like that. I'm totally speaking outside my depth here. I've never worn them or really done much research. I just know that they exist. My dad got to try on a pair at a convention the other day, and he was really raving about it. He was excited. Theta Trader, if we ever get sick of wearing glasses, VR headsets would be 10 times worse after a long day. But Theta Trader, that means it would feel 10 times better when you finally get to take them off. Everybody would be wearing those
dorky half glass, half full kind of guy.
Everybody wearing those dorky VR headsets would be the end of humanity. No one would ever get late again. What are you talking about, bro? It would become like a car. You'd have like a really cool VR headset, and people would be like, "Ooh, look at that guy's headset." That's how it would work. Oh goodness. But yeah, I agree though. I think that for it to be full scale implemented, where everybody consistently has this VR stuff going on every day, glasses type situation is probably what would be required. And honestly, I mean, are we crazy far from contacts? Is that like an insane thing to say? Like, I feel like 20 years from now, contacts are going to come into this equation, and you're just.
It's a crazy. I'm not saying it's far-fetched. It is a crazy thing to say. The idea is crazy. I don't think it's a crazy thing to say, but the idea is crazy. That's not that far. There's no way you're not working on that.
Oh, certainly. And I mean, I don't think it's any crazier than telling somebody in 2000, say, how prevalent iPhones would be in 2020 and how insanely advanced they would be relative to what you have. So yeah, I mean, if you go 20 years from now, the way technology compounds, I don't know if that's necessarily that crazy of a thing anymore.
I was of the same department. Growing up, it was I would never. This is when those Galaxy 3s started coming out. Phones weren't super massive, but they were just a little bit bigger than what we were used to. And it was a big deal, right? And then I remember seeing those phones like, why would anybody get an iPhone? They're so small. And then I remember when they made the iPhone 6, it was the first larger one that they had made. I think they really blew up after they did that. But never say never as we hop into Apple right here. Apple getting hit over the last few days. I know we have FOMC tomorrow, so we might get a little bit more volatility into these markets. But Apple a little beaten down over the last few days. And if we go into this into the options chain right here, you can see I was looking at this 200-205 vertical spread on Apple that expires next week Friday. So May 16th cycle, shorter term. I would be paying a debit. I'd be paying about $1.91 in debit for a pretty decent max profit. Again, I was looking a little further out too. I know I was originally looking in the 45 DTE. I'm comfortable. I mean, I like these levels. I'd be putting on just a little bit more risk, and then also, for this type of trade, I don't really want to be holding for a month and a half on this one. So I ended up going with the 10 days till expiration, and then also just to collect $1.75, I got to be selling that at the money. So it just lets me know, not as juicy as I would like. Could probably utilize a different strategy in this expiration if I really wanted to. But long story short, I ended up getting involved, or going to be getting involved in this 10-day cycle in Apple. So we'll keep an update on that. Let's go ahead and check out your guy Rivian over here. My guy went with Rivian and said, forget Elon and Tesla.
Yeah, let's have a look. I'm told it's down a wee bit. Also, Mike, that's a great point. The glasses closed captioning for deaf people. Never thought about that, but that would be amazing.
That's where I was thinking about why they would be great glasses. No, I'm just kidding. But very volatile right here. Yeah,
definitely trending down a little bit here. It's I don't know, not what I expected. Like I said, I left myself a ton of room. I needed over $10 or $10.50 10 days from now. So I don't have particular cause for concern, but some faster acceleration to the upside would certainly feel good.
No, I hear you. I mean, we're kind of break even right now. I mean, we're kind of flat. All things given. I mean, look at this candle right here. That's some extreme volatility.
Yeah,
that was a 5-minute candle. But yeah, we're pretty much sitting flat right now. Maybe we rally into the open.
Also, in reference to your the 45 DTE idea with Apple, I have confirmed that the 90-day pause on this Liberation Day stuff began on April 9th. So that's 90 days from April 9th.
Why is that significant? I see what you're saying.
Would you be holding through that resumption? July 8th is 90 days from April 9th. So you just want to make sure we're not getting too far outside that cycle. Well, you wouldn't be there yet with 45 days.
This was June 20. I got you.
Interested to see how the screens evolve when Gen Z ages. You hit 40 to 50 and looking at a tiny screen text becomes uncomfortable or impossible. Yeah. And Theta Trader, in a more macro context of what you just said too, just eyeballs, like our eyeballs. I worry. I shouldn't say worry, I guess, but think about that sometimes. And especially like even kids born after me, like my parents were very good about like not letting me have a lot of screen time until I was like, I don't know, 10, 11, 12. But when I was a kid, they were always like, go outside and go play with the neighborhood kids, whatever. But there's, it's evolving now to where we're giving iPads to babies. And I don't know if necessarily if being exposed to blue light from before you can even remember things, many, many hours a day. I would imagine that's going to take quite the toll on eyeballs. So long optometry, everybody. That's the sentiment there. I don't know how we get long optometry. If somebody can figure it out, please let me know.
I got a little bit of a hot take here, Gus. I got a little bit of a hot take, right? This is excluding babies with iPads, 3-year-olds with I'm talking middle school, high school, college, that age range. But also, I just have to say, parenting is extremely difficult. I see why parents give their kids the iPad. I want to do it with mine, but I see why. I mean, I see why.
Well, it's very easy to say, I wouldn't do it with mine. We don't have kids. We're a couple of guys in our early 20s sitting here bullshitting. So I always give a pass. I can't have perspective on the situation, but continue.
No, absolutely. But I gotta say, I got a little bit of a hot take. I know it may seem like communication goes down with all this technology, but I would actually argue differently. I think communication and social engagement has actually gone up. I think it's just happening in a different way. I think we have access to create group chats. I know I have group chats on other platforms with my guys from 5 years ago that we're still in, 10 years ago that we're kind of still in. Maybe not 10, that was a little bit of an exaggeration, but I do think people have the ability to be a little bit more social than they were once able to a lot more frequently, right? Face-to-face contact is really good. Reading body language, being able to read social cues, you learn and pick up on all of those things by seeing people and engaging with people in person. Excuse me. But when it comes down to the engagement in terms of talking and speaking with other people, I mean, Discord didn't blow up for no reason. It's a community where communities gather, speak amongst themselves. So I think that it's a slightly gray area because I think there's negative impacts with technology and kids or people in general not being out and being physically social with people. But that's the one argument I have with that. I was like, I think actually there's a lot of communication, maybe more than I've seen when I was 10 or when they were 12, 13, whatever the case might be. So,
well, yeah, I think that communication is certainly up, and I don't think that anyone would argue with you on that. It comes down to the psychological nuances, which you alluded to, between communication and socialization, which are two different things. And it's like, you wind up with these kids who, anytime you talk about a kid like being antisocial and having these problems that we're starting to discuss, they're probably on Reddit or in Discord talking to people all day, every day. But the reality is just that when you get out into the world, it's a little bit different. I had this friend in college, and he was kind of like, he was really, really brilliant guy, but he was kind of like a little awkward, weird. I mean, whatever. We liked him. He was I had some classes with him, and he was cool. I liked him. But he was like very antisocial. Like it took a long time before he was like really comfortable, kind of like opening up and joking around and stuff. But he would be just typing away on Discord all class, every class. Like lots of people needed him, and he's constantly communicating. But at the same time, the social skills are not all the way there. So I think that you run into those sort of weird dichotomies, and also personality mirroring in real life from the internet, which I think is becoming way more prevalent. Like we had memes, but no one was running around when we were in elementary school saying MLG Doritos like it was funny. But these kids do run around saying skibbity toilet for real. And it's because they're learning how to socialize on the internet. So it's an interesting thing.
Epitome of brain rot. Yeah, absolutely. I mean, you just saying that was like straight brain rot right there. But great points. I actually love this topic of discussion. I know we got some other good points in chat here as well, and you brought up some amazing points too. Great topic of discussion that we could go even deeper on.
Chat. You guys are killing it in chat right now. I wish I could read all these comments. We're at time, but this is really high level discussion. This is interesting stuff.
100%. Anything else to add as we head out here? We'll see how Apple and Rivian play out, but anything else?
Yeah, no, nothing to close out. Rivian might be coming. I guess that would be my closing remarks. Next 5 years, Rivian gonna be coming.
All right, there we go. Once I start shorting Rivian, it'll go up. So I got you guys first thing in the morning. But no, we'll see how these positions play out. We'll give an update back over here on Thursday, same time on some of these positions. But that's going to do it. Thanks for taking the time to hang out with us today. Be sure to stay tuned for more segments coming up on next. And we will catch you guys next time. Peace.
Are you tired of one-size-fits-all financial services? Tasty Trade is a bespoke brokerage that tailors to the unique needs of your trading style and account size. You can trade stocks, options, futures options, and crypto all on the same platform. Find stocks that fit your criteria and analyze them with studies and drawings on our charts, or keep up on a company's events and performance with our in-platform newsfeed and fundamental data. No matter where you are, you can trade with confidence on Tasty Trade. Place trades and keep track of the markets with ease on our desktop, web browser, mobile, and tablet platforms. Having any trouble? Don't worry. We have the tools and resources to help. Check out the Tasty Trade Help Center to learn about our platform, trading concepts, strategies, and more. Forget the one-size-fits-all financial services and go with the bespoke broker that can help you grow. Learn more at tastytrade.com.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards, become a trading mastermind. Get the guide at tastylive.com/guide.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Oh, yeah, it's Tuesday, May 6th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's Eating Show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. We got a special one for you today, everybody. We have with us, of course, the one, the only, the global head of macro here at Tasty Live. I'm talking, of course, of Ilya Spivak. Ilya, how are you, my friend?
It's a great day. It's sunny and beautiful here in San Francisco, and I'm in my tiny office staring at charts. So all is right with the world.
A wild day, an interesting day, especially if you account for the last 5 minutes. Now that markets have opened back up and some some inklings of the confirmations that the U.S. and China are now officially engaging in trade talks. It's so funny. We're doing this stupid sort of like ritual dance of, just opening up.
Talking about talking.
It's so stupid. Anyways, shout out to everybody watching on tape. We all know what this is too. You know what I mean? We all have to sit around and watch them do this ridiculous political dance so they can save face and work their way to the discussion. It's such a silly thing. Anyways, shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But if you want to be part of Bing, did I get it? One of these. If you want to be part of that conversation on your screen, there's only one place you can do it, and that is over on the evil Google YouTube. So head on over there, find the Tasty Live channel, subscribe to the chat, and get those phalanges and those metacarpals pumping away, both appropriate and inappropriate commentary on your screen. Do us a favor, try to keep it at least mostly appropriate. Ilya Spivak, I guess before we get into the little dance that we seem to be doing that is now confirmed, or at least looks like it's being confirmed by price action and headlines. Tell me, my friend, what was your take on today's sort of weakness that we saw during the cash open? S&P 500 was down 0.75%, NASDAQ down about 90 basis points, Dow Jones down about 1%, the Russell down 1%. Second day in a row of effective weakness. What was your take on price action today?
Well, I think we clearly had a blistering rally. It was a 9-day rally. We hadn't seen one of those in quite a long time. In fact, you have to kind of go back to the volatility around COVID to get these kind of runs. So not surprising at all for me that at the beginning of this week, the market goes, oh, wait a minute, is there something happening on Wednesday? Oh, yes, there's a giant flashing red sign of an event risk, and we've just had a really significant one-sided move in a direction. Oh, and by the way, we've erased all of the Liberation Day kind of hair on fire episode. We're exactly back to where we were before that gap kicked us off. So seems like a pretty good place to stop. Let's stop right here and just wait to get to the other side of what this event risk is going to be. I think the market is just taking a breather here. As bearish as I am, I don't think there's any confirmation that you've restarted the down move in earnest here. I think it's just the market sees the Fed in front of it and goes, that's a lot that we just did. Let's not overcommit in front of an event risk that's this significant.
Two things. There was never, nay, a single hair was on fire on this show, my friend. Let me put that out there. And why do you think?
Go ahead and look at the S&P there.
It doesn't matter.
And just highlight that was the minority position.
That's true. That's where the money is. Why do you think Wednesday is such a big deal? Maybe this is another. I don't know what my deal is lately. I don't know if I just got maybe a hormonal imbalance. But I'm just not. I don't get what why do you think Wednesday is a big deal? I don't at all.
I think it matters a tremendous amount, and
explain.
I think everything that we have seen since the beginning of this sell-off in mid-February, going into mid-March, has followed a very clear cadence. And you can even go back to November, right? We've said it a gazillion times on this show. We'll say it again. The markets were not afraid of tariffs. If they were afraid of tariffs, conceptually, they would have sold off in November at the latest.
I know a lot of people who were screaming their heads off about tariffs, though, a month ago.
Well, there's tariffs and then there's tariffs. There is tariffs, the idea of tariffs, as, for example, they existed in the first Trump administration. And then there is whatever this is. And those are different things.
Yeah, that's true. That is totally
Those are very, very different things. One of these is not like the other, as the kids say. And so what you see is the markets don't begin to have any kind of freak out until business and consumer confidence all of a sudden start to crater. And you don't see that data until you get to mid-February, because your January and February numbers start to make a line. Right? PMIs are so great because they're timely. They're released, in the case of S&P Global, the month of you get the first look. And so in January, you start to see the numbers. You go, well, okay, but this is just 1 month. Hold on a minute now. The uncertainty, handoff to a new administration. Hang on. Then you get to February and you go, wait a second, this is starting to make a line. And that's where the freak out starts to hit. Not until the markets see that businesses and consumers are pulling back from economic activity around this rollout. Not until then do the markets think that it's anything. Obviously, Liberation Day spooked them a level of magnitude greater, but we've unwound all that, and I think reasonably enough. The administration took a step back from what the markets thought was the worst case scenario and kind of very clearly signaled that's not it, especially when the bond market hit certain points of pain, let's say like 4.5 on the 10-year or something like that. And you very clearly also had a realization in markets that what looked like almost like a currency crisis for the dollar at the start of April is a ridiculous thing. Because no matter how bad things get in the US, everywhere else isn't a better alternative, even collectively, for things like a risk-free asset, which is the US Treasury bond, or a currency of commerce that is the dollar. There's just nothing else right now on this kind of time frame. You can argue until you're blue in the face that something may emerge in 10, 20, 30 gazillion years, but you cannot go and break the system now. There's just nothing there. So you have the markets unclench, rightfully so. You're back to the starting line where the story was about growth. And that story hasn't changed at all since it started in those mid-February PMI surveys. They've only become worse. You're at a standstill if you look at ISM. You're at a standstill if you look at S&P Global. The GDP numbers gave you the weakest consumption growth in almost 2 years, and that was the real story of that report. Forget the weirdness with inventory and imports. That obviously made for a much more negative number than really was there. That's not important. It's what consumption is doing. That's what's important. And so that's why I think the Fed matters. Because at the end of the day, what the markets want is they want to start fighting the recession. And the Fed's not going to give it to them, and that's going to be disappointing. The pricing is about 100 basis points, which is in line with the Fed, but the markets want 3 cuts this year, and the Fed is only giving them 2. So the markets are priced for urgency, and they're not going to have it.
I agree with all that. I still don't get, so why do you think it's such a big deal then?
Because I think that stocks will fall as a consequence of the Fed being hard vague, as it were, indicating nothing in particular. And saying, you know what, we said the fog was thick, the fog remains thick, we'll see you in June, have a nice day. And that being the extent of it. I think what the markets want in their pricing for urgency that you see in Fed funds is they want a nod to saying, look, we're almost there, everyone. We see what you see. We will come with rate cuts. Expect us in June. And I think what the Fed is not going to do is set that stage.
I agree.
And that will disappoint.
Maybe. I think
does it disappoint the stock market in like a critical back under 5,500 way? I'm not so sure. I think the bigger story might be the bond market, where the market does the same thing as what happened last year when the Fed did this same dance in the second quarter where inflation got a little hot. The Fed said, we don't want to cut. We don't want to cut. But growth was starting to turn. And then for basically mid-April into August, the market was screaming at the Fed, you need to be more dovish, and stuffing all these extra rate cuts downwind in the forecast, saying you're delaying so long, you're going to be late. But then growth surprised everyone on the upside at the end of last year. But nobody knows that that's necessarily in the cards this year. You just know that things are slowing. You want the Fed to cut. They're not doing it. So you stick more into the back end of the curve. So long rates fall.
I agree with all that. I'm short twos here. I've been short twos for a few days. I thought, I asked the question on this stream. I said 4 cuts from now to the end of the year, over or under. And then I just said to myself, under.
Yeah, under.
And so
the market even agrees that it's under now.
Yeah, now we've backed off 4. Now we're at 3, yeah. And we had that. 3, we had we for most of the year we were going to start this cutting cycle or continuation of the cutting cycle in the June meeting, and now they've effectively taken that off the table. It's a 2 out of 3
That's
chance that we don't do anything in June if they slow walk this. And that a lot of that had to do with the ISM. Repricing came after the ISM. I wonder, you've been speaking to ISMs and the PMIs since February. You said earlier that the ISMs are at a standstill. I don't know that I characterize it that way, and I'm curious why you did. So the ISM on Monday came in, I would call it stronger than expected, 51.6 versus 50.2 consensus. Can you give me, what's your read-through on that number?
So if you look at that number, it was a little bit better than expected at the headline. If you look into the details, it's a whole lot worse. But here's what I mean. Before I kind of get into the granular details, here's what I mean here. So there's 2 sets of PMIs. One comes from S&P Global. One comes from ISM. Okay. Last week, we had manufacturing from both. This week, we have services from both. Out of these, you get a composite that gives you a sense of the overall economy. And you say, here's the overall, but you have to scale it, of course, because services is a much bigger part of the economy than is manufacturing. What you get out of S&P Global is you get weaker services, slightly stronger manufacturing, evening out to almost 50, little bit warmer on the composite. What you get out of ISM is a second consecutive month of contraction on manufacturing, much worse than expected, but then you get a little bit better on services. So it surprises the other way. And that probably speaks to survey construction. But when you look at what the composite is that it implies, it is, again, a hair above 50, because the 48.7 from manufacturing, because it's a smaller piece of the whole, doesn't all the way shoot down the 51.6 on services. That's a heavier part of the basket. And so you probably end up somewhere in the 50.5, 50.4, 50.6 range on what is a composite. Now compare that with levels in the mid to upper 50s last year. We're looking at an economy that's gone from growing at the fastest rate in 2 years in the fourth quarter to barely growing at all. So that's what I mean when I say you look at the PMIs, and one of them is flavored a little bit to services, one of them is flavored a little bit to manufacturing, but the upshot for the growth of the economy is exactly the same. You're hugging 50 on both of them. So that's one thing. When you look at the services report, I think the worst part of it is you see a second consecutive month of job losses. with a blistering acceleration of inflation. So if you look at it from the Fed's standpoint, you have a strong stagflationary impulse in this thing, and it ties your hands. And that's the worst part about it.
I do not get what's going. For some reason, this screen share keeps crapping out on us. I'm not sure if it's on my end or on the other end. My apologies, Paul. Let's keep cruising. I understand. I understand it now, Ilya. I said for a while, I think maybe last week, maybe 2 weeks ago when we started this posturing between the U.S. and China, I kind of said that the confirmations of talks between the U.S. and China, I could see that as being the short-term peak in optimism for equities.
Yes.
And I sort of look at the announcement that was just made. I look at stocks rallying 1% or so, and I go, I want to fade this. Like, this is it. This is it.
Yeah.
And there's a part of me, Ilya, that almost thinks the opposite. I do think the Fed wants to slow walk these cuts, but if you put a gun to my head, as you don't go there. If you put a gun to my head and you said hawkish lean or dovish lean Wednesday, I'd actually say dovish. Not by much. I would say slightly dovish lean, and open up the cut possibility for June, keep it 50-50 versus where it is right now.
Keep it 50-50, I think is key. I agree.
Yeah.
So dovish lean, of course. Dovish lean because the Fed has been talking about rate cuts since they issued a 50 basis point cut in September of last year. It's been a dovish lean, right? The question is it going to be more of a dovish lean in a way that is more dovish than March, where basically the Fed said, we don't know what's going on. We think we know how tariffs have worked. So here's an SEP that gives you weaker growth and higher inflation. And we're not changing the rate forecast because we don't know which version of this movie we're watching or what to do next, because history is pulling us in opposite directions, but we don't know how this thing is going to actually go. So we don't know. 50-50. See you later. I don't think anything has changed since March. And I think the tone won't be more dovish relative to March, though it will be dovish in general. They've been dovish. They want to cut.
All right. I don't want to talk too much about the Fed today because I feel like there's so much going on. And to me, that's one of the least interesting of the stories. But we've covered it. So let's keep
Our
cruising.
duty is complete. Our duty to the calendar has been rendered.
Dude, talk to me about this surge in gold for the last 2 days. Not only that, not only the surge in gold, but I'm flat. I'm not flat gold. I'm mostly flat. I've got a little short call spread. I'm like short the 3,500 and 3,500 calls with something long behind it, but I'm long silver. And this move in both gold and silver was incredible. I think silver was my biggest winner on the day. Talk to me about what you think is happening there. Is this all the geopolitical? Is this all India, Pakistan? Is this what is this in your mind?
I got long on Monday, and I did it by selling put verticals here. Because,
long what? Long gold?
GLD, the ETF. So I sold puts because buying calls was expensive. Vol was already starting to creep, and so I got long the other way. I think this is a combination of things, and for me, ultimately, it boils down to what we've been talking about since the beginning of April. This idea that term premium has started to blow out in the bond market. And what that tells you is that people want to be compensated more for duration risk because the fog they're perceiving is thick and isn't lightening up on a time frame that they like. There's just so much. And you can throw into that stew India and Pakistan. You can throw in the escalation that's looming in the Middle East. You can throw in, after these Houthi missiles penetrate Israeli defenses. You can look at the Russia-Ukraine thing that seems to be hardening the lines, not the other way around, even though this minerals deal that's been talked about forever finally gets some ink on it. You get some sort of a hiccup in Europe with the forming of Germany's coalition. On and on and on. I mean, there's so much noise on noise on noise, and obviously the main story, the post-Liberation Day shenanigans out of the White House, not really sounding any more encouraging when the president goes out there and goes, you know what, maybe the kids need only 2 dolls instead of 30. And you go, wait a minute. This is not the pro-growth thing that the markets were angling for in the fourth quarter. They wanted deregulation and rate cuts. What is this? And so what are we being made to think is coming here? So all of it to me boils down to just the fog being thick and the markets building more term premium into bonds. When you get last sort of week and a half and markets unclench, term premium eases back very, very tellingly. You come off the lows, bonds bounce, stocks bounce. Dollar, very tellingly, does not revert, and gold holds up relatively well. And when you look at the beginning of May, that term premium has started to expand again. And the markets are coming back and saying, wait a second, nothing is fixed. Yes, the hair on fire moment is over. We overshot that. That was crazy. That didn't make sense. But things aren't better. They're just not extreme. And so as you see that, I think gold almost picks up a kind of war premium demand, where you see gold reflexively rally at times. Like, for example, when Russia invaded Ukraine, why was that a gold rally? What about gold makes it special in a Russia invades Ukraine scenario? Absolutely nothing. And so, but it rallies all the same, as it tends to do at times of geopolitical tension in particular, because that's the kind of stuff markets don't know how to benchmark. It's not an economic variable. It doesn't follow kind of economic thinking. It's a complete wild card. And so markets go, you know what? The fog is thick. I don't know what to do. Buy gold. When in doubt. And I think that's sort of why you have gold really since the beginning of the year on this relentless drive higher that is especially strong in April, and which seems to be restarting now. I think China coming back off their holiday and obviously being a big buyer in this market recently, I think that's helped as well. I think there was a lot of kind of pent-up speculative interest, maybe not even just in China, but just around the fact that this big gorilla of a buyer is going to wake back up. And so, and of course, it comports with bonds perking up a little bit, with the dollar weakening some more, which I know we said we're done with the Fed, but sort of sets you up for a Fed that's going to cut later.
Couldn't help himself.
I mean, it's right. It's just right there. It's sitting right there.
So, can I ask, I know we don't normally go in this direction, but explain to me, I'm looking at gold doing what it's doing.
Yeah.
And I look at Northrop Grumman. I look at Raytheon. I look at Lockheed Martin. Even Palantir today down 12%, down to 108.
Yeah.
Still expensive, but
yeah,
one of these assets is not telling the truth. Either defense stocks are not telling the truth, and that the discount that they priced in over the last couple of weeks doesn't make sense, or gold is a big old scaredy cat, scared of things that are perhaps not coming. Do you think I'm right to be thinking about it in that way?
No, I don't think so. And I don't think it's because I don't think gold is rallying because it perceives war risk. I think gold is rallying because markets don't know what to perceive. The fog is very thick. So I don't think the markets know that war is coming or that gold is rallying because it thinks that it's become more likely. I think gold is rallying because markets have concluded that there is uncertainty about everything, and that uncertainty is imperceptibly dense beyond a relatively short duration. Hence the jump in term premium back up in bond markets. I think what the market is saying is the likelihood of all kinds of unexpected stuff is greater. And that includes foundational things about the dollar and the treasury market, which would be traditional havens in times like that, where correlations go to 1 and things get spicy at a very kind of top-down level. But it's possible that the call for help might come from inside the house. And so maybe the dollar and the treasury market isn't the place to look for early safety here. And it's not that more war is coming or more this and more that. It's that the fog is so thick it's unclear what in the world is coming. And the default may be just to get more gold exposure.
Perhaps.
For lack of a better idea.
Well, I think what I've been doing is gold doesn't break enough for me to want to buy it. So at 3,500, I got short and bought it all in a couple hundred points lower, but it wasn't, in my personal opinion, wasn't cheap enough to buy. And the only thing I keep doing is messing around with the miners. So I don't think Newmont got cheap enough, but I think like Barrick Gold, which is GOLD, I think they're just on pure price alone, I think that one's okay, so offers some relative value. Maybe IAG as another one. So that's the world that I'm going. I do think the defense stocks, Ilya, I think I like them as a trade over the next 30 months. And if it doesn't work, it doesn't work. But I like the idea. I like them as a trade. I think there's a lot of people that think we're going to wrap up. We're going to wrap up Ukraine. We're going to wrap up Iran in the Middle East. I don't think so either. I think that's what there's the path there for people to see that world right now, and they're pricing in that outcome. They're pricing a lot of good outcomes right now. They're pricing in, okay, we're going to get rid of these tariffs. We're going to get global trade in order. We're going to get Ukraine solved. We're going to get Iran solved. And I'm because
tax cuts, we got to make time for tax cuts. And you go, well, this is just... And then unicorns will sprinkle rainbows down from the sky.
Exactly.
That's okay.
Everyone wants to believe that we're headed towards the happy path, but hope is not a strategy, man. And I could totally see this unraveling. In a lot of people's optimism, just like disintegrating instantly.
It's all a very flimsy foundation, which is why I keep coming back to the PMIs and why I keep coming back to growth and saying the problem is growth. Forget this nonsense. The problem is growth. Because you can afford nonsense if there's growth. You can afford all kinds of stupid stuff if there's growth. But if there's not growth, you can't afford it.
So here's what I asked this question to Tom in a very different way. And I'm curious to ask it to you from a macro perspective. So the question I asked to Tom, I go, when a stock rallies, does it matter if it's a short covering rally or if it's like a bona fide rally where markets are getting actually long? And he goes, no, of course not. Stupid question. So let me ask you the same thing. If we pulled forward a bunch of buying in the first quarter, does it matter why we purchased in the first quarter, or does it only matter that there was purchasing in the first quarter? Because a lot of people want to.
And for what?
I know, but a lot of people
matter for what?
A lot of people want to read through any positivity in building of inventories or purchases because it was front-running tariffs. And I suppose my question, Ilya, is: does it really matter, in your opinion?
I mean,
and
again,
break it down.
So, let's start here. We have to ask: does it matter for who?
Mm-hmm.
Does it matter for consumers that shelves won't be empty even if there is an effective embargo on the most critical supply chain in the world? Of course it matters. Obviously. If you walk into Walmart and there's stuff on the shelves, it matters that it's there because you need it to be there. And Americans, I don't care what the president says about $2 instead of 30 or whatever other nonsense, but he's telling Americans not to consume? What? Who are we? What is this? What country do we live in?
Let's stick on this point for a second.
Okay.
There was a part of me when I listened to that, when I listened to him say that, I had two thoughts right away. I thought of the "let them eat cake" line, but it was "let them have $3." I thought "let them have $3."
Let them have $3. It went from 2 to 3 over the course of about 48 hours. I'm like, oh, we got an extra doll. Here we go. Let me tell my daughter she's only going to get 3 because the president is magnanimous.
So there was a total aspect of like "let them have $3" thing in there for me, and then there was a part where if you're a parent, like I'm like, yes, we.
No, I get it. I get it. I just don't want the president to be talking.
100%. That's where it is.
I just don't want the president to be telling us that we need to tighten our belts for no understandable reason.
I don't know. It's like there was a way to deliver that line. Like a JFK. Ask not what what our country can do for us. Ask what we can do for. There was a way to deliver that line, and to sort of move the country in a way that says we need to focus on having more meaning in our lives. And perhaps the pathway to more meaning is not cheap Chinese toys that we can buy on Amazon.
That was not it.
And so there's a way to deliver that message without it sounding like I hereby announce nobody can buy more than $3, like it sounding like that. But so I'm of two minds. I get the ethos of what he's trying to communicate to the people. I get why that's important, because if you don't start seeding that out, and you're really going to try to change the balance of trade, you're going to try to change where we're making this stuff, people got to get used to the idea that you might be buying a slightly more expensive doll. You might be buying a more expensive doll to keep somebody employed, and you got to start getting that message out there if you're serious about this. But it didn't hit right. It definitely didn't hit right.
No, and if the people were behind the president, if he'd sold this well.
Oh, I am. On this point.
No, I'm saying if you are not a statistically significant sample, if the people as a whole were behind this, then the University of Michigan and the Conference Board would not be reporting what they're reporting.
That's so funny. You know what? I think the people are of two minds too. I think you can get a bunch of people.
They voted for it, but they're not behind this, what they're seeing implementation wise.
Here's what I'm saying. I think you can tell a bunch of people that I'm going to bring prices down, and everyone's like, yes. And then a few months later, you go, okay, are you guys ready for the recession? And everyone's like, wait, what? Everyone.
Yeah, right.
That sounds right. People want this stuff, but they don't want to pay for it. You know what I'm saying?
Right.
We want more jobs. Okay, you ready to have $3 instead of 30? What? What do you mean? It's like we want the shit, but we don't want to pay for it.
Well, that's what I'm saying. There's not buy-in for what is turning out to be the thing, and that's creating sticker shock. And you see it in the consumer confidence numbers and the business confidence numbers where people go, wait, hold on. What? And so from the perspective of consumers, of course, it makes a difference that shelves won't be empty. They need stuff on the shelves. From the perspective of businesses that are gonna sell this stuff, it'll go into earnings. That's fine. From the perspective of us as traders, not investors that might not care and say, you know what, does it really matter for the 10-year, 20-year outlook for these companies that I'm going to buy and hold for all eternity? No, it doesn't matter. But for us as traders, does it matter? Of course it matters. And it matters because it tells you that these are not things you can extrapolate into the second quarter and the third. And so it matters for what then the underlying message in GDP is, because that's going to dictate near-term Fed policy and what bonds do and what stocks do and what currencies do as markets navigate this environment. So for consumers, it matters in a very visceral way. For businesses, it matters in they get to survive without significant disruption for longer and maybe even charge more and pad their margins, much as they did during the shortages of COVID. Companies are absolutely going to take the opportunity to gouge here and blame the White House and say, see, it's the bad tariff man that's doing this to you. Meanwhile, money. So it's not necessarily bad for them, but it matters. It doesn't matter for the buy and hold investor. But for those of us operating on, let's say, a 45-day DTE cycle, it matters.
Fair enough. Totally fair. Let's go to some instruments here. I want to know where you're positioned and why, starting with the dollar. I'm a little bit long US dollars. Mm-hmm. I almost I almost never take explicit positions in currencies. I usually have an opinion, but I express that opinion implicitly through other instruments. But right now, I'm long US dollars relative to the euro. I wonder what you think about that and how you're positioned.
I'm short. I started putting shorts back.
What? Short dollars?
Short the dollar. I started putting it on with the Aussie last week. The Aussie, unlike the euro, which is pinned inside its range and doesn't want to go anywhere, seemingly. I think it is, by the way, very interesting that no matter where you look in the dollar, right? Stocks rebounded from April's scare. Bonds rebounded, then came back down, but ultimately are in a much better sort of spot than they were at kind of the peak, holy moly, from last month. But the dollar never really came back. It has sustained those losses. And that is not a market that looks like it wants to recover just on those grounds alone. The underlying weakness here, like either the dollar is late or everything else is wrong. Mm-hmm. And I'm inclined to think that the dollar is actually right. It is the most liquid market by far, FX is, and it's oftentimes the smartest too. So I think when you look at that sort of underlying reluctance for people to buy dollars, I think that tells you something. The Aussie started to break out of its congestion higher last week, so I started layering that on. And then the BOJ gave you a really great mulligan with the yen. The BOJ came out a little bit dovish last week and kind of watered down some of their intent to hike rates. And they justified it by saying, oh, well, you know, this tariff fog is so thick, we don't know what to do. Let's wait and see for a second here. Maybe we don't hike anymore this year. Our outlook has become fuzzier. And the yen weakened on that, and I thought, Well, that's exactly the opposite of what the response from the yen is to what will be lower U.S. interest rates as a consequence of exactly the growth scare that the BOJ just pointed a finger at. Okay, this is going to mean lower yields. That's not a weaker yen. That's a stronger yen. And not for BOJ reasons, because the BOJ is an afterthought anyway. Rates in Japan are so low, yield differentials only matter while the BOJ is literally talking about them that day or intervening because something is weird. But other than that, yield differentials in the yen are not a reason for the yen to go higher. Falling yields, though, absolutely. And so I got a little bit long yen as well. So right after the BOJ, after that yen sell-off. To your point, the euro is not seeing it, the pound is not seeing it, the Canadian dollar is not seeing it. So it's not by any means uniform. It's more like Asia is rallying against the dollar. Let's see what that means. I'm not prepared to sell the euro or to buy the euro yet here, or the pound especially. There's a Bank of England meeting this week as well. We'll see what it does. But I'm long those currencies against the dollar. I want to be long the euro as well. But I think that'll just take some time for it to kind of find its footing. I'm long gold. I'm short all three of the key stock indexes that we follow through put verticals, SPY, the Qs, and IWM, which is
whoa. Hold on. You're getting way too ahead of me here. Let's go one at a time. So I hate being on the opposite side of you in currencies. I hate it. So, but there's a part of me that goes.
You're in the euro, and I think you might be. Yeah, I'm not prepared. I'm not prepared to be on the other side of you on the euro. That one's different.
So talk to me about where you are. I know you're long bonds. I can't for the life of me figure out why. I'm trying to talk you out of it.
So last week I got out of bonds with a little bit.
No, this is what you want to be in them now.
Well, no, and then today I got back in.
Yeah, I think the flattener works here. Like if I was going to do anything, and I kind of am, I'm not long. I don't think I'm long bonds. I think I'm mostly flat bonds, but I'm short the twos. And I don't have the confidence to be long bonds, but if I was going to do anything, I'd be long bonds with short twos on, because I do think the potential for a flattening of the curve along with a strengthening of the dollar, I think that's in the cards here, because nobody's positioned that way. So if only for a sort of a reflexive contrarian move for the lack of positioning in this direction, I could totally see us, the short end of the curve, moving higher, meaning people price less cuts into the front end of the curve, which then allows people more confidence to buy the long end of the curve, and by that nature alone, you get some strengthening in the U.S. currency. I think I'm thinking about that in the right terms. So I am positioned for that. And
I actually think that gives you a weaker dollar.
Why?
Because I think what it does is it shifts cuts into the back, but it also shifts more of them into the back. And we saw this in spades last year. So again, when the Fed was resisting in the first and second quarter of last year, the market said, you're going to be late. You're going to miss the recession. You could be doing stuff now, but no. So you're going to be late again. And what that means is you're going to have to cut harder because there'll be more work to do. So if you look at the interchange last year between rate cuts priced in for 2024, they basically went nowhere from mid-April until August. But the outlook for 2025 started to blow out. And the cumulative outlook started to get more and more and more dovish. and the dollar was getting smashed. Because the markets were going, the Fed is going to have to throw the kitchen sink at this when it realizes that it's wrong.
Yeah, but it's the market.
And the thing is, the Fed did. The Fed did throw the kitchen sink at it.
The market's been wrong in 2024. It was wrong. It's been wrong in 2025.
But they weren't that wrong, because again, the Fed is kind of, the Fed and the markets are in this dance where the markets go, you're gonna be late. Then the Fed goes, okay, here. And they do throw the kitchen sink at it in September. But by the time they do that, growth is already recovering, and the markets go, well, yeah, but we don't want it now. We wanted it then. But the thing is, this is sort of what I've been saying before about Fed.
It's a good point.
About Fed judo is the Fed lets the markets get all hype up, lets the froth build speculatively, then leans in, and the markets go, whoa, wait, really? Okay, that's too much. And they get walked off a ledge by their own recoil at what the Fed then does. So here, this is the build-up stage. This is the stage where the markets go, you got to cut, you got to cut, you got to cut. And the Fed goes, no, we will not. And delay. And the markets go, right, so 2026, let's put another 50 basis points in there. Let's take it out of this year and put this and some into next year. And so the long end rallies.
Interesting. Okay. I think that's I didn't think about,
and the dollar
that was one aspect I didn't think about, which is putting more cuts into next year.
Yeah. Because they'll need to put more than they take out of this year for the they'll be late adjustment. They'll have to go harder because they'll be behind the growth curve.
Do you think they're behind already? What's your personal opinion?
Yes.
Do you think so? 4 cuts between now and the end of the year, over or under?
I think under, because they're going to delay. They're not going to have enough time.
Too.
They're not going to have enough time. I think they'll realize that they're late, but they always do. They're reacting.
I said that same thing yesterday. I go, this is the dance.
But that's
they wait. It's a feature. That's right.
It's a feature.
That's what they want to do.
You can't expect them with a medium term 2 to 3 year mandate on growth and inflation to jump at every shadow. You don't want them to do that. They're not in the business of keeping us perfectly steady at 2% inflation at all time. First of all, that's impossible. And second of all, it would create so much volatility in the economy that to constantly go back and forth, fine-tuning rates to that extent, what would they be even good for? They're supposed to be a steadying hand over a 2 to 3 year window that smooths the business cycle, not turns it off. That's impossible. We wouldn't want them to attempt it. So people are always like, oh, the Fed is always wrong. No, the Fed operates on a 2 to 3 year window and is reactive to evidence at that time scale, which is exactly what you want of them.
Let me ask you this. Crude oil is almost exactly at $60. It's about $1 lower.
Yeah.
Does crude trade with what happens first? Crude trades with a 40 handle or crude trades with a 70 handle? What happens first?
40 handle. Opinion? 40 handle.
Explain what you think is happening there and why.
I think crude has done probably all of the imminent falling that it's needed to do when it's kind of settled in an area here. It probably has some room to digest. I was short all the way up until basically the end of last week, and then I got out and took my my profits there and just backed up because it looked like we were getting into an area where there's going to be a sticking point of some sort. I think it's high comedy that there was a gap down because people took an OPEC plus statement seriously. OPEC plus doesn't matter. They can't control the market. They can't discipline their membership. They have not been able to hit their quota once since they were created. This whole artifice is complete circus. But they did say, oh, we're going to pump more oil. Okay, so the prices gap. They hang out at the swing bottoms for a second. We've now, I would argue, correctly undone that entire gap because they don't matter and nobody cares. But in order for oil to really come off, you need a growth scare that people see in real terms, much as the Fed needs one. And I think some of the annoying stuff in the recent news flow has been how malleable it is. Like the GDP report, it's like, pick your own adventure. Do you want the slowdown in consumption, or do you want to dismiss the entire thing because, oh, tariff weirdness? It's too fuzzy, I don't know. The jobs report, 47K better than expected, but the previous month was revised down by 48K. What's the difference? Have we learned anything new about the jobs market? Not a thing.
The same thing will happen when inflation numbers come out in a few months.
BCE numbers come out.
It'll tick higher, but then people will be like,
yeah, lowest core since June. But the run rates, 3-month annualized, 6-month annualized, take a little baby tick down from a crazy spike in February, and you go, well, when this happened last year, the Fed waited like 6 months before they believed that it was actually still going down. And we're only 1 month in. They don't know anything. Nothing has changed. So, from crude's perspective, it needs to see like a nasty growth number, something that's real and tangible. And then you go, yeah, demand destruction. Okay. It needs the next catalyst. I think it's already adjusted down to what is a growth scare. It needs now the next kind of incremental point in the story to go, okay, there is a deeper downturn and it's here now, and we can mark down demand.
There's a weird part of me. That thinks in the same way I thought we'd see short-term optimism peak when U.S.-China trade deals. We could see the U.S.-China confirming their talks would be the short-term peak in optimism. Some part of me thinks that I want to really start getting long energy companies if and when Russia and Ukraine do a deal. Like, I think that'll be sort of like at that moment, there's less of an incentive to keep the pressure on crude oil lower. I think.
Then everybody's going to start investing in things again, and all of a sudden pumping more throughput through the whole thing. Yeah, no, that would be a big unclenching. Correct. There's a lot of money that's on the sidelines waiting to be deployed, and that'll be more of a pull on crude supply because all of a sudden everybody's going to want to refine more and ship more and all kinds of things. It'll create a level of activity, as it were.
Yes. I always want to go to Bitcoin with you, and then I stop myself because you're just like this big rain cloud over the Bitcoin conversation.
Did you love the Coinbase ad this week?
Oh, I fucking loved it, man.
I knew you would. First thing I saw it, and I'm like, I bet Victor loves this.
I thought about you. I go, Ilya probably doesn't like this. Ilya probably has so much shit to talk about. I looked at it
as an Economist cover type of indicator.
No, you didn't, because you're still short. You're still short dollars.
Yes, but I am not long Bitcoin.
Oh, okay, fair.
And I'm not short dollars for the reasons that the ad purports.
I know. That's the part. That's the part I think you would have
anything remotely like it. No. No.
Dude, it's so
I'm
obvious.
short the dollars because I think yields are going down. We're going to cut rates, gold up, bonds up, rates down.
I think you're too smart for your own good sometimes. You know that? Like, I think you.
If I blindly bought Bitcoin, I would be much happier financially, but I would still be talking all this smack.
You're so invested in this is the thing. You're so invested in the U.S. financial system that it would be hard for you. I think it'd be hard for you to let go of all that dogma. It would be hard for you to let it all go because you're so emotionally, intellectually, and financially invested in the U.S. financial system as is.
I am certainly invested in the idea that this is as a student of history, I know that this is the best it's ever been, and to go backwards would be highly undesirable because I know what's on the other side of it.
But that's not the only. So that's a false choice.
So that's one thing.
Mm-hmm.
That's one thing. So in that sense, of course, I'm invested. I think it's the better option of what we know exists. I don't think it's by any means impervious to improvement, and in fact, its malleability and its improvements over the decades, I think is the only reason that it's survived. Otherwise, it would have caved in long ago. It's been renegotiated and rebuilt, and its rules changed. And the problems that the changes make then becoming the new thing to fix, and the flexibility with which it changes those things, I think are a feature, and an important feature. And so I don't by any means think that it is beyond improvement, not even close to it. It has
You don't think it's a
so
problem?
much room for improvement.
You don't think it's a problem that we're all playing this game and that the rules of the game, when certain parties or participants, when they are threatened, then the whole dynamics of the game, the rules change. But
I don't think it's ever been different ever.
That's not what I'm saying. When I'm threatened personally, I have to deal within the constraints of the game. But certain participants have the capability and the capacity to change the entirety of the rules for the whole system when they are threatened. You don't have an issue with that?
Of course I have an issue with that, but do I think this version of it is better than the feudal version?
Isn't that status quo? Isn't that status quo, that what you're doing, that's a status quo cognitive bias. What you're saying is
it's not.
You're afraid of change.
Not at all.
That the devil is better than the devil
that
you
is
don't
exactly the opposite of what I just said. I said this system is badly in need of change, is perpetually in need of change, is never beyond improvement, and the great feature of this version of the system
but it's not
is that it has proven itself malleable enough.
You understand?
No.
It's that you're calling it an improvement, but I'm saying that's dogma. What improvement
It's not dogma.
It saves some other player, some big politically important player. They change the rules not to improve the system, but to save themselves from bad decisions.
Let's live in reality. This is the fiction can be fun, but I find the reference section much more enlightening.
Bro, it's like I want to be mad at you for that backhanded thing, but it's such a funny reference. It's such a good reference.
How good is that movie? That's one of the first movies in my American life that I really loved and was fanned out about.
Can be fun.
So let's not confuse what we have here as, of course, corruption and domination by an elite and this and this and this with feudalism, where everybody lived in hovels and 10 people controlled everything and could cut off your head at will.
False choices.
It's not a false choice.
In this argument,
it's
you
progress.
create now versus a false choice.
I'm not saying there's a risk of backsliding to that. I am saying that continues to exist today all over the world in a lot of places. Not all places, but it's not a stretch. That kind of feudal life exists, let's say, in Saudi Arabia right now. So,
but you're arguing.
My point is, we have a
whole.
system. My point is, we have a system that has many, many faults, but which is the best version of a system that humanity has come up with up until this point, and needs to continue to iterate that system, but not to burn it down and in service of some sort of revivalist fantasy, because there is nothing to revive.
When I agree with you. You can't. Both of those things can't be true. You can't say we need to have progress and improve, iterate, but then also there's nothing to.
There's no great past to go back to. We need to go forward.
Can I ask you, Ilya?
Not tear down.
QE1, QE2, QE3, QE4, Operation Twist, ZERP. In your mind, these were improvements, or these were saving people's ass?
These were saving people's ass.
These were transfers.
And by transfers of wealth. No. They were transfers. Well, yes, but so they were inadvertent transfers of wealth.
Come on, bro.
Absolutely. That ultimately saved
inadvertent. You think
regular people much more so than the people to whom they transferred the wealth.
Look,
the marginal benefit from those wealth transfers was much harder hitting for the people who lost in the bargain. When you look at paper wealth transfer, because billionaires got a little bit more paper wealth in their assets and went from billionaires to multi-billionaires. But their standard of living was not going to get terribly impacted anyway.
Yeah, I think
if the worst happened in 2008. So the unclogging of credit markets and the saving of what could have been another Great Depression, but worse because of greater interconnectivity and deeper credit dependence. That helped regular people much more than what they lost in the paper wealth Olympics. And they did. They did lose in the paper wealth Olympics. But the upshot of saving the economy, in my mind, was so much more important.
Do you think we created moral hazard in the economy? Do you think there's moral hazard in the economy?
Yes, of course. But there's always moral hazard in the economy. The question is, did we make it greater? And I think the answer is, of course, yes. Of course, yes.
Do you think we live in a capitalist system right now in America?
I don't think there is such a thing. I think what there is the natural tendency of economic actors to pursue their self-interest. And the more and what capitalism is the belief that if you enable those actors to pursue those interests in as unfettered a way as possible without hurting other actors doing the same thing, you get better outcomes. Better is relative because you have to decide what better means for you. Sometimes cheaper prices are not what you societally decide is better. But I think there's many versions of capitalism. Because the way you negotiate what my pursuit not getting in the way of your pursuit means, you come to different outcomes. But I think that's why I think capitalism is not a system. Capitalism is the absence of a system. Capitalism is letting people's self-interest and enterprises' self-interest just do what it does. And what the system is are different versions of what we negotiate to come up with societally, quote-unquote, good outcomes. And obviously we're in the middle of that now, obviously, where we say, you know what, it made sense in the 80s to optimize for the cheapest possible prices because the war carried over from the 70s was inflation. And so we went to, okay, cheapest possible prices, lowest common denominator, maximize shareholder value, crush the economy with high interest rates, all of those things. At every level, we reinvented it then. And now we need to reinvent it again, because it turns out that the cheapest possible prices also meant that while everybody got cheaper washing machines and cars, some people, that didn't matter because they lost their job making the washing machines and the cars. And so for them, the whole thing was a net cost. And as we typically do, we only focused on the broadest possible benefit and didn't think that maybe we don't need to keep 100 cents of every dollar of savings. We could keep 70 cents and have strategic reserves of, let's say, steel and whatever else, and keep people employed. And yes, then steel would be a little bit more expensive, but we would have a societal reason why we say, you know what, we don't need rock bottom cheap steel. We want cheaper steel. And there's a middle ground here. We didn't do that, so now we're solving that issue, and we're going to reinvent it again.
Do you think? So one of the things that the last two administrations seem to have in common, at least partially, is a desire to onshore/nearshore for strategic areas of the economy. So things like critical materials, pharmaceuticals, technology like chips and AI, and energy.
That clearly makes sense, yeah.
And I wonder, I wonder what you think about that as a political goal to deglobalize in these four strategic areas for a matter of national security.
I think it makes perfect sense, and I think it's in line with the renegotiation of what this system is all around the world, and of course starting with us, because we created the order that we're now restructuring. After World War II, it made all the sense in the world for us to have a globalized order, because Europe was in shambles. All our factories remained, and we said, free trade, everybody. We're about to get rich selling you stuff. And of course, that dovetailed with us dealing with an inflationary issue then after we got rich, and that post-war gambit worked. And then we tried to solve that by relieving inflationary pressure. Lowest common denominator on production prices, on labor costs, high interest rates, Volcker, as we just talked about. All of these things operate in concert because although they look like they're disparate policies, they always, at the end of the day, are tailored to what the fundamental issue for the median voter is. And the fundamental issue for the median voter right now is we've hollowed out the middle class, we've widened wealth disparities, and externally, we thought that we could moderate China to play ball globally and buy into a global system, and they cheated and decided that what they wanted, again, well within their prerogative, it's just we bet wrong. They decided what they wanted to play for was geostrategic advantage, and now we have to counter that. And we had a window to counter it diplomatically. I would argue the TPP in the Obama administration was a very elegant way to counter, but we didn't. We ultimately dropped that ball. And now we have to counter in a way that sort of revives a Monroe Doctrine 2.0, where we basically say this Western Hemisphere is ours. By all means, come do business, but don't stay. We run things here. This is our sphere. And then moving supply chains to South America and Mexico, where, frankly, they probably would have gone were China not to have made the offer of stability and forecastability that they made in the 90s. And we took that bet, and turned out wasn't the bet to make longer term. It worked at the time. It worked great at the time. Hundreds of thousands, if not millions of people were lifted out of poverty because it worked so well. But now it's created consequences of its own because nothing is free, right? First page of any economics textbook. There's no such thing as a free lunch. Every time we fix a thing, we create an issue. And then the next crisis is we fix that issue. Now we have to fix the income inequality and the hollowing out of strategic manufacturing. Because, let's face it, Americans don't want to sew socks. We're not bringing that back from China. It's not going to happen. When we are talking about strategic manufacturing, though, like the refining of rare earths, the building of semiconductors, all of these things. Now, obviously, there's a tremendous defense advantage there that, given the way the geopolitics have worked out, we now have to do. And that helps you to deal with all manner of other issues like the income inequality. So, yes, of course it makes sense, and yes, of course it's bipartisan, because at the end of the day, that's what the median voter wants, and that's what the median voter is going to get, by hook or by crook.
Mm-mm. You mentioned something that I hear a lot, that we are rewriting the order that we ourselves created, and I don't know if you meant it with negative connotation, but I am curious.
Positive.
Yeah, because I hear that said all the time lately, and I'm going, yeah, we always do that.
No, of course. No,
we constructed Bretton Woods. We went off the gold standard.
Because it served us at the time.
I'm trying to set this up.
Yeah. I'm saying
we structured the Plaza Accord. We are at this every time the game breaks and needs to be rewritten. We are the ones who have rewritten it. So there's like this line out there.
Era. Because we're the big dogs.
Yeah, post Bretton Woods. Post Bretton Woods. Yes, that's what I'm saying.
Yes. No, you're absolutely right. I completely agree. Which is why, on the one hand, when people start to scream, oh, this order was so good, why are we breaking it? We're breaking it because the median voter wants it broken.
Mm-hmm.
It doesn't want it torched. It wants it reframed again. It wants the system to iterate. This is a forcing function.
And the other thing you mentioned, which I find interesting, because I've said this on this show before, that if you're fixing one thing and you create a whole new problem somewhere else that's often bigger, the only person who actually wins is the politician, because they, for some short time, get to ride the wave of the idea that something was actually fixed, and but the people end up getting shortchanged because it's this big game of whack-a-mole. So I guess my question to you is like,
I think that depends. That depends, because
I know
fixing inflation in the 70s was a 40-50 year dividend for everybody. But it's had costs, big costs.
Where does inflation come from, man?
Well, we
created
the inflation by engineering an economic boom. That's where the inflation comes from. And then we had to open markets to let the air out of it.
Okay.
I mean, again, it depends. If you're fixing a little problem in the sort of historical sense, right? Like Bill Clinton went around thumping his chest saying, oh, I took us from deficit to surplus. Yeah, for like a year. Okay, yeah. But does that erase the entire pile of national debt up to that point? Of course it doesn't. So, okay, you solved what? But then, does that big pile need solving? Well, that depends. Because if that big pile makes you the risk-free asset in a globalized financial system, then you can borrow forever because you've essentially locked yourself in as the best borrower as a function of the way the system works. And that's obviously a huge advantage. So you're right, I think, when it comes to the kind of things that can be paraded around in a 4-year electoral cycle. Most of that stuff is nonsense. And that's and that's why I think you have to look at the bigger sweep. Like, we made for ourselves an industrial boom. That industrial boom post-war generated tremendous power for us to shape institutions, to write the global rules order, but it also gave us 12% inflation that we then had to fix. Like, should we not have had the boom? No, we just then had an inflation problem that we had to fix, and then for 40 years we had an amazing period of prosperity when we fixed it. But now the new issue has emerged, and when we fix it, we'll have another 40, 50 years of good time, and then that will have a cost.
I wonder if we just made like a generation of libertarians. I kind of feel like a millennial.
I mean,
I wish I could pull a bunch of people my age and be like, do you think these guys can fix anything? I think most people my age would go, hell no.
But that's part of it. It's not the people doing it. That's why the key things are bipartisan. The system is evolving.
I think the most dangerous things are bipartisan.
The thing is evolving. The thing is renegotiating itself.
Yep.
It's renegotiating itself, and it will reward those that do it. And if Trump comes out there and goes, I will help to renegotiate these things, because I don't think anybody can argue he's been diagnosing the issue correctly for a decade and then some. His solutions, we can quibble about. And some people say these are the correct solutions, and some people will say they're not. But why has he been so successful? Because he has successfully diagnosed what everybody on both sides is collectively upset about in their mass.
Yeah, I agree.
And then it's small group of people that says, no, everything is fine, look, everything is great, they keep losing elections.
Correct. Yes, I agree with that 1,000%. Like the people that are like, don't believe your lying eyes.
Yeah.
Like that is not
work. How much more of a consensus candidate for the previous thing that people want reformed is someone like a Hillary Clinton or a Jeb Bush? Right?
I don't get the question. Just ask it again.
It's not party oriented. It's the person that can articulate the will of the median voter at the turning point surprises everybody. This is how it happens forever. This is a cycle in its painful stage, the transition stage.
Normally, you and I have the conversation we're about to have. We have it off air. Yeah. And I find this is the most interesting, Ilya Spivak. I mean, all the stuff that you spew, that you impart is, I think, fascinating. But this is the most interesting part. Let me ask you this question. I'm sort of fascinated by what Dems are doing at the national political level, like putting AOC and Bernie out front. Bernie's out front, but he's also saying right away, hey, I'm not running, which is a weird political tactic, in my opinion. What do you think? To your point, I think you're 100% right in diagnosing what happened in the last election. There was one candidate willing to speak to the problems of the American people, and there was one candidate that was like just unwilling, perhaps bound by donor money, to speak to those issues, or just was incapable of doing it. Where do you think the Dems go from here into 2028, Ilya Spivak? What do they do to be competitive in your mind?
I don't think what you're seeing from AOC or Bernie represents where the party is going. I think it represents where the party is not going, because the party isn't going anywhere. I think when you look at populists of the left or right, at any moment in time, the nature of populist politics is it is rah-rah, loud, by its conception. Doesn't matter who it is.
Agreed.
But whether it's AOC or it's Nigel Farage, who cares? The nature of a populist approach from the right or the left is you got to be barnstorming all the time.
Mm-hmm.
So AOC and Bernie, they're just doing AOC and Bernie. They're always doing AOC and Bernie. You just hear them louder because the mainstream of the Democratic Party is real quiet. Because they don't know what they're doing. And they're not saying anything. They are in the proverbial political wilderness, but very, very obviously so. Like, they're not even trying to front like they're not. And I think what's starting to emerge is the affinity of a number of, and I haven't read Abundance yet, the Ezra Klein book, but people seem to be starting to tie together this kind of quote-unquote abundance movement coming out of the American Democratic Party, where you're seeing the parties switch. And we've seen this happen before, where suddenly the Democrats find themselves the party of free trade. Suddenly the Democrats find, and I mean, it's not that new, but like, as opposed to Republicans that aren't, this is weird and different. You're seeing suddenly the Democrats becoming the party of an assertive foreign policy, countering Russia in Ukraine as opposed to appeasement and isolationism. Again, what? This is like Cheney-esque. Why? This is different. But I think what you're seeing is what you ultimately should have read from the 2020 general election, where Democrats ran every flavor of the harder left and skewed hard that way across 25 different options. And what the voters did was they went with dependable centrist Biden. Or at least that was the sell of the options at the time.
That was the sell, but they forced Bernie out.
What happened later is not important.
And they forced the field out.
They
forced them to coalesce around Biden.
What happened later is a separate issue. The primary voters told you what they wanted. And what they wanted was not the extreme left.
I think Bernie was winning the primary in 2020.
What you then see, because you continue to see it, I mean, I'm in San Francisco. My finger is on the pulse for what is one of the most weather vane cities for a particular bend of left. You could see the tide come out of it here in real time. With the mayor, with recalls of the DA and parts of the school board. COVID was a big shift here. And emanating from the Bay, as it always does, is a huge cultural shift nationally. We didn't only invent American cuisine. We also invented all kinds of other things. And as ever, you see it happen. I think the next thing out of the Democratic Party, I don't think will necessarily be Josh Shapiro, but it will be a Josh Shapiro, which is to say a results-minded centrist saying, we hear you, we're just going to execute in a competent way, and we really mean it, and we're going to really try to do it.
Why do you think Newsom or Pritzker won't be the leading candidate in 2028?
I don't have a strong opinion on Pritzker. I don't know enough about him, or like I don't have enough contact with his vibe. Newsom I know because he used to be mayor of San Francisco and is now governor of California. I've been following Newsom's career for a really, really long time.
He's also a podcast host in his spare time.
He's also a podcast host, and he's having a lot of the kind of conversations that lead me to think that the Democrats are shifting toward the center,
100%.
Not the left. And there's a lot of that. Buttigieg is back out there doing the Buttigieg thing, which was the sort of we need centrism, but not old centrism, smarter new centrism. centrism. He's been on that since, again, the 2020 election. You could see who the people were rewarding in that election. And he did get pushed out. But you get a sense where they're going and that the other thing didn't work. And I think with Newsom, he's just way too tainted by the old vibes for people to take him credibly. I think that was in large part the issue with Kamala. She was just way too tainted with the previous thing. I think people want solutions to their issues. I think Trump articulated the issues, but he's not selling the solutions. If all of this is in fact a genius effort that's going to eventually work, the majority of people don't see the vision. Not yet. Maybe they will eventually. I don't know, but I don't think that they're going to, because I don't think this is the way to go about it. But that's
They've called it strategic uncertainty, which I think is hilarious. I've said it on this show. I think what he likes to do is keep the range of the hand open as wide as possible. And politically, if you start to articulate what you're trying to do, one, you open yourself up for counter, and then two, you have to wear that position. And he doesn't like to wear positions. And it's funny because he gave I think it was what's the news network, or with Cuomo, the whatever network that Cuomo's
News Nation.
News Nation, thank you very much.
Yeah.
I think Trump did a call-in interview with him, Bill O'Reilly, and Stephen A. Smith. One day you and I should talk about Stephen A. But one of the things he said is they talked about him not articulating what was going on to the American public. It was something to that effect. And he said almost exactly what we had said on the show, which is like, he goes, I need to be able to be flexible. And he goes, so this will come step by step, but I need to be able to be flexible. And so it's like, on one end, it takes a tremendous amount of trust from the American public to just take this massive gamble without a true vision that's been articulated, and you kind of got to put the pieces together yourself and hope that you're seeing it the right way. And people are putting the pieces together in totally different ways and saying this is what's happening. And you just kind of leave a lot of open room for chaos, for argument, and what you don't have is national cohesion. And I think that's the biggest risk of this time. Regardless if are we attacking the right policies or not? Are we going to win in these negotiations? Whatever win means. The big risk that we're running right now is a complete lack of national cohesion. And going into tough times, if that's in fact what we're doing, or rebuilding something from scratch, or modifying something that is so important. In order to do that, in order to introduce big levels of change into a system, you need buy-in by the participants of the system, which means you need cohesion. I think that's one of our biggest risks.
Well, yes.
Right now.
And the problem is that most people agree there is cohesion on what the problem is across almost everyone. I would argue a vast majority. If you listed top 5 priority issues, the overlap would be huge. Only very late in the game would you get to the cultural differences, where the majority of what you would say is the American left has actually moved more to the center, or you would say more of the people that just didn't care about those things started to speak up because they felt like things got out of whack in a direction. I would think from the other side, there's a far less extreme position than what you might say is articulated by the talking heads on that side. And so there's, I think, vast agreement over what the major issues are, and vast disagreement as to who is going to fix these things and how.
Yeah, I also think there's a bunch of false choices. I think, and this
which is why I think we're going through a kind of reformation of where the parties are and who they are.
The problem is
who they field.
One of the problems is I want to vote for free speech.
who's that person? Because I see on one side of the aisle sacred cows I can't talk about, and then on the other side of the aisle there's these set of different sacred cows that you can't talk about.
These are brown, those are spotted, all cows though, and everybody wants to protect their herd.
I want to. Where's the one that goes? You can talk about. You can say whatever. You know what I mean? That
There's
we protect this value.
There's a theory out there, and I don't want to co-opt anybody else's work, but there's a lot of overlapping ones. The most recent one I read was George Friedman's version. Dalio talks about this kind of stuff. You mentioned the fourth turning. That's another kind of a theme. And they all kind of land on this idea of Howard Marks talks about it in terms of credit cycles, that there's a little cycle and a big cycle, and one of them is more frequent, the other one is less so, but that there is basically a 50-year institutional cycle. And we're just to the end of one, like right around now. And so what this is, basically going into the next election, going into 2028 and ultimately into 2030, that what this is kind of the last gasp of the transition. And that the next administration will come out of a world in which the parties have rearranged, the order is different, what they stand for is different, and now we get the first kind of real steps of what the next thing is. That this is sort of the last bit of the transmutation, which is, of course, the most painful part.
And somehow, folks, that was the result of me asking Ilya his thoughts on Bitcoin. That's going to do it for us here today. Do me a favor, hit the like button before you get out of here. Subscribe to the channel. Ilya, if the people want more from you, and I'm sure they do, tell them where they can go.
As ever, I am all over the PM part of the Tasty Live day, overtime after the close, then macro money on Tuesdays. This show, although we've been kind of playing it fast and loose with Tuesdays and Wednesdays, Chris and I.
You know what? I just stopped telling people who on Mondays. I just go, somebody will be here tomorrow.
Yeah, one of these macro dudes in glasses is going to show up both of these days. No telling which one. And then speaking of Chris, I'm on with him for Futures Power Hour Mondays and Fridays to bookend the week. I'm writing for the News and Insights part of tastylive.com, and I'm on both the platform formerly known as Twitter and on Blue Sky because I am everywhere and not biased either way, at Ilya Spivak.
My man. If you want to follow me, at Victor Jones, the O in Jones is a 0. Because I like to be difficult. Ilya, I say this every time, 90 minutes, not enough, my friend. I enjoy it more and more each week. I look forward to our next conversation. Thanks for coming and hanging out and imparting your wisdom.
Always a pleasure.
For everyone else out there, I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Until then, peace.
Peace.